Hello and welcome to our special coverage of the monetary policy. Hello and welcome to an all-important monetary policy coverage from CNBC-TV18. Big day for us. We complete 25 years and it's almost as if divine grace that the Reserve Bank has chosen to date an all-important policy on this day. So we feel it's a double delight for us. Well, I tried my luck. We were with our cameras waiting to welcome the governor into the Reserve Bank. I tried asking him, sir, any goodie bag for us? And of course, he smiled and said, you will know. And of course, we're going to know in 10 minutes or so. We have a battery of guests and my colleague Ritu Singh, who did the CNBC-TV18 poll. So welcome, Ritu, and over to you. The poll says that there isn't a repo rate cut just yet.
Yes, Lata, in fact, 100% of our respondents say no repo rate cuts. So for the 11th consecutive time, a status quo policy. But to acknowledge this slowdown in growth, there could be a dovish commentary from the governor. And instead of a rate cut, there are some chances. There's a section of the market that is expecting a cash reserve ratio cut ranging between 25 to 50 basis points. But the chances of that happening, according to our poll, are 50-50. So we'll have to see how that plays out. In terms of when the next repo rate cut could be, largely now the market is aligned with February. That's when we'll start to see the rate cut cycle. In terms of the other parameters, of course, the GDP number is going to get all of the eyeballs. 7.2% is the number. It has to be revised down. To what extent, we'll have to see. Our poll says about 6.4 to 6.7%. Inflation currently at 4.5% for the year might have to be revised upwards. Our poll again says between 4.8 to 4.9%. Some even say 4.6 to 4.7%. Apart from this, a lot of focus will be on the liquidity measures, whether there is a VRR, some sort of OMO purchases. What the governor does to assure the market that liquidity will remain comfortable is also something that everybody will be watching out for. And of course, the big question mark, the Reserve Bank of India governor's tenure, that ends on the 10th of December. We're yet to hear from the government on that front as well.
Can't hear it. Thanks for that comprehensive poll analysis, Ritu. Let's invite our guests. We have Kaushik Das, the chief economist from Deutsche Bank. We have Indranil Pan of Yes Bank, with Devang Shah of Axis AMC, and I think Lakshmi Iyer of Kotak is going to be with us in just a minute. Actually, let me start, because it's a CRR cut cry, let me start with the market guy first. Devang, what are your bets? CRR cut for sure?
Yeah, we are more in the CRR cut camp. So yes, definitely, as Ritu highlighted and you highlighted, growth has actually come lower and rang some alarm bells. But we believe that the need of the hour is actually liquidity, which would be supportive both for credit growth and the economy on the longer term. Hence, our view is that RBI should be looking at liquidity infusing measures today and probably start with rate cuts from Feb. We also believe that this is in sync with their monetary policy stance, which they announced last policy. So I'll go with CRR cut.
All right. Well, let me get to Kaushik. Kaushik, is there a chance of an accommodative stance?
Lata, that is too early. They changed the stance to neutral. Even, you can cut rates with a neutral stance. So it doesn't stop them from cutting rates as well. Now, the question that you asked, I think, we are going with the base case scenario of a CRR cut. And we gave that call even before the GDP data came out, because liquidity was getting, tight in the system. So if you need to do a rate cut for the transmission to happen effectively, you need liquidity to improve. And therefore, I think after changing the stance to neutral, the good sequencing would be to cut the CRR. CRR is at 4.5. For the longest time, it was at 4% before COVID, so it can come down. And then you cut the rates in February and April. But with RBI, you never know. It can always give you a surprise and cut rates today itself, saying that we are a forward-looking central bank. Inflation is expected to come down. So if you have to cut in February, why wait? And, they can deliver a cut in December itself. But that's not our base case view as of now. We think CRR cut is more likely, followed by a repo rate cut in February and April.
Okay, let's get Lakshmi in. Lakshmi, your call. What's in for today? Is a CRR cut almost a given now?
Yeah, hi Lata, good morning. So yes, there is, though the core system liquidity obviously is much lower than what it was in September. But, taking cue from what Kaushik just mentioned, I'm actually reminded of a quote by, which is attributed, of course, to John Maynard Keynes, that if the facts change, I change my mind, what would you do, sir? So if that question were to be posed to the governor, clearly the mellow down in GDP growth definitely points to a case to definitely look at a possibility of a rate cut. Of course, I know it's a non-popular view and obviously not our base case view as well, but it's a very, very outer chance. But clearly, if you signal something to that effect, so today I think more than walk, it is more about the talk. So a combination of CRR plus probably even open market operations, that's something which the markets have been indicating or expecting. I think a combination of either or should keep the market, I would say not euphoria, but should keep the market mood intact, which right now is definitely expecting a significant dovish undertone.
Well, so net, the market is expecting some cues from the RBI governor that liquidity will be kept comfortable. Whether that is through a CRR cut or not, we'll have to see. N18L, our experts here, unanimous in their expectations of a CRR cut today from the governor. I know you have a contrarian view, so tell us about that.
We are not expecting a CRR cut, neither are we expecting any rate cut. Rate cut, I think everybody is on the consensus view, though some of my colleagues here sort of tend to be on a knife edge and they can fall on either side. But I think with a 6.21% inflation reading and with Trump policies coming whereby global interest rates and inflation can remain on the firmer side, it's possibly not the right time to do a repo rate cut. Yes, growth has been slowing down, but there are also consensus views coming that some amount of the slowdown is because of certain factors which were not in the control, including the fact that there was a base effect from the previous year. And some of the early indicators that we see for October is pointing to a more stable growth. It's quite not true that we would be or we should have been expecting a 7.5% growth in an atmosphere where the global growth is on the negative footing. And I would be happy to see a more qualitatively good growth at around 6.5% or so, which is where we are sort of tending, and more normalization into the pre-COVID sort of situation. So I'm not, and in terms of the CRR, I think CRR is a more permanent liquidity infusion. And the banking system liquidity, which is, I actually look at more the banking system liquidity rather than the government balances included, which is the core liquidity. And given today's situation, I'm not expecting a CRR cut. Yes, they will be absolutely clear about the fact that they would be nimble-footed in terms of adjusting liquidity as the need may be. I would prefer to see the RBI more on an OMO journey, because there is space there to sort of ramp up the rupee securities as the foreign securities have also sort of fallen.
Okay, so that's a 3:1 on the possibility of a CRR cut. Kaushik, very briefly, let me pick up from where N18L left on the growth numbers. That is where a lot of focus again is going to be. 7.2%, most likely will be lowered. But to what extent is the question? Because there's some in the market all the way down to a 6 to 6.3% kind of a range.
So, Ritu, in order to get 6.5%, you need to have 6.9 or 7% average for the second half of the year. We have a 6.5% average for the full year. And, that brings in, factors in 6.9% growth. The reason being government spending will pick up in the next few months. And, you probably could see a bounce back even in October, December. Manufacturing activity is expected to be better than July, September. So all built together, probably you will get, close to 6.9, which can lead to 6.5% growth. But the risks are obviously to the downside, because the second half of the fiscal year will have to contend with a very high base year of the previous year. We had high growth last year on, absolute terms. So it could be challenged to get close to 6.9. RBI had a growth forecast of 7.4% for second half of the fiscal year. if they keep that constant with the first half growth that you've got, RBI could come down to 6.7, 6.8. But ideally, they should be at 6.5 or lower to do the proper mark to market, for this year. And more importantly, next year, RBI has a growth forecast of about 7%. We are at 6.5%. So the story that we think is building up is that India is probably going to be at 6.5% average growth for some time, which is below potential. And therefore, you need some monetary policy support to make sure that growth doesn't fall below 6.5 for the next few quarters or years, given that the global backdrop is going to become challenging. The tariff wars and other things from the US administration could slow down global growth. To that extent, if India is continuing to do fiscal consolidation, and we think India will reduce the fiscal deficit again next year to 4.5% or lower, then you need some monetary policy support, and some repo rate cut of 50 to 75 basis points is needed in this cycle.
Yeah, Kaushik, we are running out of time. Kaushik, we are running out of time. Devang, just give me the bond yield range you are expecting over the next 1 month. Just a quick one.
660 to 670.
Okay, and Indranil, any guess on the rupee?
I think by March end, we should be at 85 to 85.25.
85.25. Okay, there has been a bit of a quiet on the dollar, and some bit of risk is coming back. Maybe it's just excessive short positions on other currencies that are getting covered, but the dollar has shaved off a bit. There is still the non-farm payroll, and there is always the possibility of any Trump statement coming over the weekend. So the markets will have to watch, the currency markets in particular, as to how they react. Over to you, Ritu. I think it's the last few seconds before the governor takes over.
That's right. We're standing by to hear from the governor at 10 a.m. So any moment now, just to recount what our guests have been saying in the meantime, the large majority is leaning towards not a repo rate cut, but a cash reserve ratio cut. It could range between 25 to 50 basis points. So 50 basis points will release about 1.15 trillion rupees of liquidity into the system. So that will bring some relief to the banking sector. Apart from that, the GDP number, again, will be the focus area. RBI will have to climb it down from the 7.2% currently, even if we get a 7.4% in the second half. So the expectation is anywhere between 6.5 plus minus 20 basis points. We'll have to see where that goes. And, on the inflation front, 4.5% is the current projection. How much that is raised, we'll have to see. Again, our, poll says anywhere between, 20 to 50 basis point, sort of revision. That could likely come. 50% expecting a 4.8 to 4.9. Here are the governor.
Every 2 months, I have been presenting the monetary policy statement on behalf of the Monetary Policy Committee and the Reserve Bank of India before you. In fact, a detailed, elaborate statement presenting before all of you is a practice which we started during the period of the COVID, when there were lockdowns and restrictions. We considered that this was the most appropriate way of communicating with the people and with every stakeholder in the economy. Monetary policy is important because it affects the life of people. It affects each and every segment of the economy, howsoever small or big. It affects the vegetable vendors. It affects the big corporates. It affects the middle class. I think it also affects the farmers, the industry, the business. So it has wide-ranging impact on the economy, and that is why I'm sure that is the reason why most of you are listening to the governor's statement. Our effort is to follow the flexible inflation targeting framework as provided in the Reserve Bank of India Act. The Act provides that the Reserve Bank, that is the Monetary Policy Committee, is expected to maintain price stability. In fact, it is a mandate. The mandate given to the Reserve Bank of India is to maintain price stability while supporting or keeping in mind the objective of growth. Price stability is important for the people because it affects their purchasing power. It is important for stability of businesses. It is important for exporters and importers. It is important for every segment of the economy. So price stability is important. At the same time, growth is also very important. As an economy, India has been growing in the last 3 years at more than 8%. Growth, that is the GDP growth, the growth of the gross domestic product, is also very important. And as provided in the law, it is always our effort at the Reserve Bank of India, it is also the effort of the Monetary Policy Committee to follow the provision of the law as embedded, as provided for in the Reserve Bank of India in letter and spirit. So with these opening remarks, I present before you the monetary policy statement of today. And this is how it goes. As we stand at the threshold of 2025, let me reflect upon the eventful journey of 2024. In line with the trend in the last few years, central banks were once again put to the ultimate test to stabilize their economies against continuous, colossal, and complex shocks. Central banks are constantly adapting to the new global economic and financial landscape created by geopolitical conflicts, geoeconomic fragmentation, financial market volatility, and continuing uncertainties, all of which are testing the resilience of the global economy. The last mile of disinflation is turning out to be prolonged and arduous, both for the advanced economies as well as the emerging market economies, that is the EMEs. Maintaining macroeconomic and financial stability and building buffers continue to be the lodestar, especially for the emerging market economies. In India, notwithstanding the recent aberration in growth and inflation trajectories, the economy continues its journey on a sustained and balanced path towards progress. Amidst the reshaping of the global economy, India is well positioned to benefit from the emerging trends as it forges ahead on a transformative journey. Let me now turn to the decisions and deliberations of the Monetary Policy Committee, which met on 4th, 5th, and today 6th December. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook, the Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%. The MPC also decided unanimously to continue with the neutral stance and to remain unambiguously focused on a durable alignment of inflation with the target, while supporting growth. I shall now briefly set out the rationale for these decisions. The MPC took note of the recent slowdown in the growth momentum, which translates into a downward revision in the growth forecast for the current year. Going forward into the second half of this year and the next year, the MPC assessed the growth outlook to be resilient, but warranting close monitoring. Inflation, on the other hand, surged above the upper tolerance band of 6% in October, driven by a sharp uptick in food inflation. Food inflation pressures are likely to linger in Q3 of the current financial year and start easing only from the Q4 of the current financial year, that is from January to March. And we expect that this is the trend, and it will be backed by seasonal correction in vegetables prices, Kharif harvest arrivals, likely good Rabi output, and adequate cereal buffer stocks. High inflation reduces the disposable income in the hands of consumers and dents private consumption, which negatively impacts the real GDP growth. The increasing incidence of adverse weather events, heightened geopolitical uncertainties, and financial market volatility pose upside risks to inflation. The MPC believes that only with durable price stability can strong foundations be secured for high growth. The MPC remains committed to restoring the inflation growth balance. I repeat, the MPC remains committed to restoring the inflation growth balance in the overall interest of the economy. Accordingly, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting, and also to continue with the neutral stance of monetary policy, as it provides flexibility to monitor and assess the outlook on inflation and growth, and then go on to act appropriately. I would now like to provide an assessment of growth and inflation, and I would like to begin with the global growth scenario. The global economy has shown unusual resilience in 2024, despite several headwinds. Inflation is gradually moving towards the target from its multi-decadal highs, prompting several central banks to embark on policy pivots. Global trade remains resilient, with increasing volumes confined within geographical blocks. Since the last MPC meeting, financial markets have remained edgy amidst rising US dollar and hardening bond yields, resulting in large capital outflows from emerging markets and also in volatility in equity markets. Going forward, the outlook is clouded by rising tendencies of protectionism. I'm talking about the global economy. Going forward, the outlook is clouded by rising tendencies of protectionism, which have the potential to undermine global growth and also push inflation higher. Let me now turn to the domestic growth situation. Growth in real GDP in the second quarter of this year at 5.4% turned out to be much lower than anticipated. This decline in growth was caused mainly by a substantial deceleration in the industrial growth from 7.4% in the first quarter to 2.1% in the second quarter due to subdued performance of manufacturing companies, contraction in mining activity, and lower electricity demand. The weaknesses in the manufacturing sector, however, was not broad-based, but was limited to specific sectors such as petroleum products, iron and steel, and cement. Going forward, high-frequency indicators available so far suggest that the slowdown in domestic economic activity bottomed out in the second quarter of this year, and it has since recovered, aided by strong festive demand and pickup in rural activities. Agricultural growth is supported by healthy kharif crop production, higher reservoir levels, and better rabi sowing. Industrial activity is expected to normalize and recover from the lows of the previous quarter. The end of the monsoon season and the expected pickup in government capital expenditure may also provide some impetus to cement as well as iron and steel sectors. Mining and electricity are also expected to normalize post the monsoon-related disruptions. I specifically commented on these sectors, that is on manufacturing, on electricity, and also on mining and iron and steel, as well as on cement, because these were the sectors, particularly in manufacturing, mining, and electricity demand, which were the principal factors which pulled down the GDP number in second quarter. So that's why I have focused how these three sectors are expected to behave in the current quarter as well as in the next quarter. The Purchasing Managers Index, that is PMI for manufacturing at 56.5 for November, remained elevated. The supply chain pressures eased in October-November and fell below the historical average. The services sector continues to grow at a strong pace. PMI services remained steady at 58.4 in November, indicating continued expansion. On the demand side, rural demand is trending upwards, while urban demand shows some moderation on a high base. Government consumption is improving. Investment activity is also expected to improve. On the external front, merchandise exports expanded by 17.2% in October, while services exports continued to post upbeat growth at 22.3% in October. Taking all these factors into consideration, real GDP growth for 2024-25, that is the current year, is now projected at 6.6%, with Q3 at 6.8% and Q4 at 7.2%. Real GDP growth for the first quarter of 25-26 is projected at 6.9% and the second quarter of 25-26 at 7.3%. The risks are evenly balanced. I would now like to focus on inflation. Inflation increased sharply in September and October 2024, led by an unanticipated increase in food prices. Core inflation, though at subdued levels, also registered a pickup in October. Fuel group remained in deflation for the 14th consecutive month in October. In the near term, despite some softening, lingering food price pressures are likely to keep headline inflation elevated in the third quarter, that is, in the quarter October to December. Going ahead, a good Rabi season would be critical to the softening of food inflation pressures. Early indications point to adequate soil moisture content and reservoir levels, conducive for Rabi sowing. The estimates of record Kharif production should bring relief to elevated prices of rice and tur dal in particular. Vegetable prices are also expected to see a seasonal winter correction. On the upside, the evolving trajectory of domestic edible oil prices following the hike in import duties and rise in their global prices need to be monitored closely. Manufacturing and services firms surveyed by the Reserve Bank point to firming up of input costs and selling prices in the fourth quarter of the current financial year, that is in the quarter January to March. Taking all these factors into consideration, CPI inflation for the current financial year, that is 24-25, is projected at 4.8%, with Q3 at 5.7%, Q4 at 4.5%. Going into the next financial year, CPI inflation for the first quarter of 25-26 is projected at 4.6% and Q2 at 4%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? I have described the growth conditions. I have described the inflation conditions. Now, what do all these factors mean for monetary policy? And that is what I would like to now highlight. The near-term inflation and growth outcomes in India have turned somewhat adverse since the last monetary policy in October. The medium-term prognosis on inflation suggests further alignment with the target, while growth is expected to pick up its momentum. Persistent high inflation reduces the purchasing power of consumers and adversely affects both consumption and investment demand. The overall implication of these factors for growth is negative. Therefore, price stability is essential for sustained growth. On the other hand, a growth slowdown, if it lingers beyond a point, may need policy support. The Reserve Bank's anti-inflationary monetary policy stance has been a crucial factor in bringing about a significant disinflation. Going forward, as food price shocks wane, headline inflation is expected to ease and realign with the target as per our projections, which I just read out. At present, it is necessary to draw on the flexibility provided by the neutral stance of monetary policy to wait for and monitor the incoming data for confirmation of the decline in inflation. The gains achieved so far in the broad direction of disinflation, notwithstanding the recent upticks, need to be preserved. At the same time, the growth trajectory and the evolving outlook also need to be monitored very closely. At this critical juncture, prudence and practicality demand that we remain careful and sensitive to the dynamically evolving situation with all its complexities and ramifications. A status quo in monetary policy in this meeting of the MPC has thus become appropriate and essential. I would now like to turn to liquidity and financial market conditions. System liquidity as represented by the net position under the LAF, that is net LAF, that is net liquidity adjustment facility, it continued to remain in surplus during October and November on account of higher government spending, despite a significant increase in currency in circulation during the festive season and capital flows. Of course, towards the end of November, for a few days, the liquidity became tight, but overall, I think there was adequate liquidity both in October and November, and it remained in surplus. Given these conditions, the Reserve Bank mainly conducted variable rate reverse repo operations, that is VRRR operations, to absorb surplus liquidity. To alleviate temporary liquidity tightness because of large GST outflows, however, fine-tuning variable rate repo operations, that is VRR operations, were conducted intermittently during October and November. The two-way liquidity operations of the Reserve Bank ensured close alignment of the interbank overnight rate with the policy repo rate. Transmission to the credit market has been satisfactory. As you would have noticed, as in the previous monetary policy statements, a lot of data is given in the footnotes. So those of you who are interested may have a look at the footnotes, because the data in the footnotes justify and back up whatever I am saying as a part of my statement. Now, even as liquidity in the banking system remains adequate, system liquidity may tighten in the coming months due to tax outflows, increase in currency in circulation, and volatility in capital flows. To ease the potential liquidity stress, it has now been decided to reduce the cash reserve ratio, that is, to reduce the CRR of all banks to 4% of net demand and time liabilities, that is NDTL. And this will be done in two equal tranches of 25 basis points each, with effect from the fortnight beginning December 14th and December 28th. This will restore the CRR to 4% of NDTL, which was in fact the prevailing rate before commencement of the policy tightening cycle in April 2022. The reduction in CRR is consistent with the neutral policy stance and would increase primary liquidity of about rupees 1.16 lakh crore, that is 1,16,000 crore, to the banking system. Going forward, the Reserve Bank will continue to be nimble and proactive in its liquidity management operations to ensure that money market interest rates evolve in an orderly manner and the productive requirements of the economy are met. During 2024-25, that is from the period April to November, the Indian rupee depreciated by 1.3%, largely due to pressure from strengthening US dollar and selling pressure by foreign portfolio investors, especially in October and November. Nevertheless, both the depreciation of the Indian rupee and its volatility was less compared to its EME peers. And this reflects India's strong macroeconomic fundamentals and improvement in the external sector outlook. The Reserve Bank's exchange rate policy has remained consistent over the years, and it is market determined. Its central tenet is to maintain orderliness and stability without compromising market efficiency. Foreign exchange reserves are deployed judiciously to mitigate undue volatility, maintain market confidence, anchor expectations, and preserve overall financial stability. These interventions focus on smoothing excessive and disruptive volatility rather than targeting any specific exchange rate level or band. At the same time, our effort to deepen and modernize the foreign exchange market have also yielded significant results in terms of, first, widening access and participation, and second, ensuring efficiency and ensuring efficient price discovery. Our overall approach ensures that forex reserves act as shock absorbers, safeguarding the economy from external spillovers, while supporting competitive and orderly market conditions. The flexible or market-determined exchange rate regime is not merely a tool for managing external shocks. It is an important element of our approach to macroeconomic and financial stability. By combining market discipline with prudent intervention, we have created a system that supports stability, resilience, and growth. Let me now focus on financial stability. The financial parameters of banks and NBFCs continue to be strong. The incoming data suggest that the gap between growth of credit and deposits of scheduled commercial banks has narrowed, with deposits keeping pace with loan growth. In fact, on the financial sector, I can say with confidence that I think the health of the financial sector today is perhaps at one of its best in a long time. The Reserve Bank supervision of the financial sector and its entities continues to be vigilant and proactive. Incipient signs of stress, if any, either at the systemic or entity levels, are monitored closely and proactive action is initiated. The effort is always to resolve the issues non-disruptively. Continuous engagement is held over several months, sometimes even exceeding 1 year, with the regulated entities. Only in extreme cases where sufficient corrective action is not visible, the Reserve Bank resorts to imposition of business restrictions as a last resort in the interest of consumers and financial stability. In fact, there are a large number of entities where the corrective action is taken and where we simply do not take any action because the response by the regulated entities is found to be, very proactive and, very responsive. And so in many cases, without imposing any restrictions on their business or other kinds of activities, the problem gets resolved. Obviously, the list is not known outside. That list is much longer. And the total number of entities, I'm not being defensive about it or in any way. Why I'm emphasizing on this is that this is something which we have to do in the interest of stability of the system as well as the stability and health of the individual entities. So only in extreme cases where sufficient corrective action is not visible, the Reserve Bank resorts to imposition of business restrictions as a last resort in the interest of consumers and financial stability. To address the issues of unclaimed deposits, inoperative accounts and frozen accounts due to pendency of KYC updation, banks have been advised very recently once again to take necessary steps urgently to bring down the number of such accounts and make the process hassle-free. Further, banks have been advised to segregate the accounts of beneficiaries of various central and state government schemes through direct benefit transfer, that is DBT, and facilitate uninterrupted credit of the DBT amounts into their accounts, and also utilization of the DBT amounts by the account holders. And we have advised the banks to do it without inconveniencing such vulnerable segments of customers, because the DBT beneficiaries are usually, and they are the vulnerable sections of the society. So being fully mindful of that, we have emphasized that there should be a kind of a seamless and smooth flow of DBT amounts into the bank accounts of such individuals in a situation so that it facilitates, the individuals to withdraw the money to meet their various requirements. Progress made by individual banks in this regard will be monitored by the Reserve Bank. I would now like to turn to the external sector. The statement today is a bit, because we have too many announcements, so I request your continued patience. External sector. India's merchandise exports expanded at a 28-month high pace in October. Merchandise imports also increased for the 7th consecutive month. Services exports sustained buoyancy and posed double-digit growth in second quarter as well as in October 2024. The robust services exports, together with strong remittance receipts, are expected to keep the current account deficit within sustainable levels during 24-25. On the external financing side, gross FDI to India increased at a robust pace. I'm talking about gross. The gross FDI to India increased at a robust pace during the first half of the year. Net FDI, however, moderated during this period due to higher repatriations and rising outward FDI. Foreign portfolio investment, that is FPI inflows to EMEs have generally declined in October. Net FPI inflows to India stands at US $9.3 billion so far in the current year, that is from April to December 4th. And this was supported mainly by inflows in the debt segment. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to the last year. India's external sector remains resilient, as reflected in various key indicators where India has been consistently performing well. And the key indicators and the data they are given in the footnotes. In order to attract more capital flows, in order to attract more capital inflows, it has been decided to increase the interest rate ceilings on FCNRB deposits. Accordingly, effective from today, banks are permitted to raise FCNRB deposits of 1 year to less than 3 years maturity at rates not exceeding the ceiling of overnight alternate reference rate, that is overnight ARR, plus 400 basis points as against 200 basis points at present. So in addition to the overnight ARR, currently the banks are allowed a spread of 250 basis points, that is being increased to 400 basis points. Similarly, for deposits of 3 to 5 years maturity, the ceiling has been increased to overnight ARR plus 500 basis points as against 300 basis points at present. This relaxation will be available till 31st March 2025. I shall now announce certain additional measures. I again request your patience because the additional measures, they are very important. The first one relates to the FX retail platform, and this is how it is. The FX retail platform, which was launched in 2019, is now proposed to be linked with the Bharat Connect platform of the NPCI. This would enable users to transact on the FX retail platform through mobile apps of banks and non-bank payment system providers. This will expand the reach of FX retail platform, enhance user experience, and promote fairness and transparency in pricing with adequate safeguards. The second announcement relates to introduction of secured overnight rupee rate, SORR, a benchmark based on secured money markets. With a view to further develop the interest rate derivative market in India and improve the credibility of interest rate benchmarks, the Reserve Bank proposes to introduce a new benchmark, namely secured overnight rupee rate, that is SORR, which is based on all secured money market transactions, that is overnight market repo as well as TREPS. The third announcement relates to Connect to Regulate, an initiative for open regulation. As part of Reserve Bank's consultative approach in framing regulations, a new program, namely Connect to Regulate, will be launched under the ongoing RBI at 90 commemorative events. A dedicated section in the Reserve Bank's website will be made available for stakeholders to share their ideas and inputs on specific topics. So we will give out a specific topic on that. We are not going to upload a discussion paper or anything, but we will just mention the topic, and we would like all stakeholders to give their opinion, suggestion and thoughts to the RBI. So it is that makes our process of consultation much wider and much more flexible, which has been our approach over the last few years. Next announcement is introduction of podcast facility as an additional medium of communication. Over the years, the Reserve Bank has expanded its communication toolkit and techniques to enhance transparency and better connect with the people. In continuance of this endeavor, the Reserve Bank proposes to add podcasts to its communication toolkit for wider dissemination of information. And the next announcement which I am going to read out is very important for the agricultural sector, especially for small farmers. And that relates to collateral-free agricultural loan enhancement of limit. The limit for collateral agricultural loans was last revised in 2019. Taking into account the rise in agricultural input costs and overall inflation, it has been decided to increase the limit for collateral-free agriculture loans from rupees 1.6 lakh crore per borrower to rupees 2 lakh per borrower. This will further enhance credit availability for small and marginal farmers. The next announcement relates to UPI. I am sorry. A credit line on UPI was launched in September 2023 and was made available through scheduled commercial banks. It has now been decided to permit small finance banks also to extend pre-sanctioned credit lines through the UPI. This will further deepen financial inclusion and enhance formal credit, particularly for the new-to-credit customers. Next announcement relates to artificial intelligence, its deployment in a very prudent manner. The financial sector landscape is witnessing rapid transformation enabled by technologies such as AI, tokenization, cloud computing, etc. In order to harness the benefits from these technologies, while addressing the associated risks such as algorithmic bias, explainability, data privacy, etc., a committee comprising of experts from diverse fields will be set up to recommend a framework for responsible and ethical enablement of AI. I repeat, a framework for responsible and ethical enablement of AI, and the acronym is FREE AI in the financial sector. The last announcement relates to dealing with mule accounts. As part of the Reserve Bank's continued efforts to prevent and mitigate digital frauds, an innovative AI/ML-based model, namely the MuleHunter.ai, has been developed by the Reserve Bank Innovation Hub at Bengaluru. This will help the banks to deal with the issue of mule accounts expeditiously and reduce digital frauds. Let me now conclude. The world today is characterized by intricate complexities and profound uncertainties. As a central bank, our job is that of an anchor of stability and confidence, which would ensure that the economy achieves sustained high growth. Since the last policy, that is since the October policy, inflation has been on the upside while there has been a moderation in growth. Accordingly, the MPC has adopted a prudent and cautious approach in this meeting to wait for better visibility on the growth and inflation outlook. At such a critical juncture, prudence, practicality, and timing, I repeat, at such a critical juncture, prudence, practicality, and timing of decisions become even more critical. Our endeavor in the Reserve Bank has always been to implement timely and carefully calibrated measures to derive the maximum impact. This will continue to be the guiding principle for all future actions also. As Mahatma Gandhi had said, and I quote, "There is nothing that cannot be attained by patience and equanimity." In the last few years, we have traversed one of the most difficult periods in the history of the Indian economy and perhaps in the global economy. And this has been a very difficult period in the economic history, in the history of Indian economy and the global economy, just as I pointed out. It was a period of relentless turbulence and jolts. As a country, we can derive satisfaction that the Indian economy has not just navigated this period of trials successfully, but has emerged stronger. As we strive together towards making India a developed economy, I recall what I had said in my statement of February 8, 2023, wherein I had quoted Netaji Subhash Chandra Bose, "Never lose your faith in the destiny of India." Thank you. Namaskar.
Okay, so as expected, no repo cut, but a CRR cut of 50 basis. No stinginess, not 25 spaced out, but a clear 1.16 lakh crore coming into the banking system. I'm not surprised that the Bank Nifty is the one that is most triumphant. We've not seen much of a move in the bond yields because, after all, there is no repo change. In fact, the bond yield went up about 3 or 4 basis points and then came down. But the important point was the last few words he said, that we believe in prudent, timely spacing of steps. Is there any hidden word over there in terms of when the repo cut comes in? And if you looked at the way in which they have given us future inflation forecasts, while they have raised the inflation forecast for the current year and even for Q1 of next year, the new number we have is Q2 of next year, which is what? 4%. So is that an indication that in February, given that you can see 4%, the RBI can argue that we are aligning towards the target? Should we take a clue from there is what the market will be asking itself. On GDP, I think the acknowledgement that we are at 6.8 in the current quarter, they're not even working with 7, is perhaps welcome, and therefore the 7.2 of Q4, which is the new forecast, will hold more credibility. At 6.6% for the full year, the Reserve Bank still remains one of the highest on the street in terms of growth forecast. The highest we got otherwise was 6.5. But markets and most of us perhaps outguessed the Reserve Bank correctly on both the interest rate front and on the CRR front. We have a very diverse panel of experts with us. We have economists, we have bond dealers, and we have a banker. And today it's the banker who's most important. Rajiv Anand, the Deputy Managing Director at Axis Bank. Rajiv, what does the CRR cut mean? Does it mean deposit rates have peaked for now?
Clearly, I think the fact that we're going to get over 1 lakh crores of liquidity into the system clearly indicates that one of the things that I've been mentioning is that overnight rates are at 6.5%. on the margin, 1-year deposit rates are anything between 7.5% to 8%. In an environment where the next move is certainly down, that gap is just too much. And I think with this CRR cut, we are going to see deposit rates come off over the next 3 months or so. So a very simple answer to the question that you're asking: have deposit rates peaked? Absolutely.
For most banks, the NIMs would rise by about 3 to 5 basis points.
I think that's a fair estimate. Remember, the impact is not going to come through in this quarter, but it will come through, from the next quarter onwards. But I think an estimate of 3 to 5 basis points is about right.
And when may lending rates go down, you think?
There is no reason for lending rates to go down at this point in time. Anyway, we've seen a significant reduction in
deposit rates have peaked.
But remember that on the corporate side, pricing is quite tight anyway, and we've seen a slowdown on the credit side over the last 3 to 4 months, and so therefore I don't expect any material move as far as lending rates are concerned. And remember that much of the book is now EBLR linked, and so therefore you should expect a material change only when the repo rate changes, which, given the expectations on inflation, look like it's been pushed out by some time.
Oh, by some time. See, that's the question now to the economists. Upasana, he said something in the end about how our policies are prudent, timely, practical. So are you reading a rate cut in February, especially because the second quarter forecast for CPI is 4%?
Yes, Lata, as you correctly mentioned, I think there are 2-3 aspects to this. One, while RBI has revised down their estimates, they still remain on an average in the second half of the year at 7%. We see a fair amount of downside to that. Yes. And as we see incremental, more high-frequency data coming in, the RBI too will come to realize that there is downside to their own estimates. That's one. Two, of course, the second quarter second quarter inflation reading at 4% is suggestive that from henceforth, 6 months down the line, that is what RBI should be focusing on, how they are looking at inflation trajectory, and that disinflation towards the last mile is being achieved by 6 to 9 months down the line. And I think that's when we do see a window open for the February rate cut. Much will, of course, depend on how the global environment will, of course, pan out. And that is going to be playing a very important role in determining the timing. Yeah. But I think definitely the February rate cut is on the table.
Yeah, it's on the table. Of course, Jan 20th, Trump takes office. So, as you say, the governor will have one eye on the external matters, inflows, outflows, value of the dollar. But for the moment, actually, there's a bit of celebration in the rupee market as well. The rupee has moved stronger from where it began. We are now south of 84.6, moving towards 84.58, 84.57. That's quite a bit of a gain that the rupee has seen. Kaushik, first takeaways from what the governor has said, especially in terms of when you expect a cut.
So Lata, we are very happy. This is extremely prudent and practical decision because we were in favor of a CRR cut first to improve the liquidity and then do a repo rate cut at some point, which we think will be February. Because I think January-March inflation will also fall to 4% because October-December we are going to get something like 5.5, 5.6 average. Therefore, the disinflation of vegetable prices will be very strong in January, February. So not just April, June, I think the first half of 2025, you could have a situation where inflation is at 4%. And RBI is always forward-looking. So when they come to February, after having, kind of done the CRR cut and before the sequencing of changing the stance to neutral, I think February will be a good time to start the rate cut. Not because data is very poor at that point of time, but you're looking ahead in the next 2-3 quarters and taking a call. If you don't cut at that point of time, whether you'll be behind the curve. And I think February will be a good time after the budget because we think the fiscal consolidation will continue. And therefore, you need some monetary policy support. RBI is saying 6.6 And you're pointing out that there is some downside risk to that as well. And we know that 6.5, 6.6 for India's growth is below potential. So in order to keep it at 6.5, 7 with this global, backdrop of, Trump administration, you need some monetary policy support. And I think 50 basis points rate cut over February and April will make a lot of sense. We also believe that at some point, RBI will push the short-term rates to the SDF and have an effective easing of 75 basis points in this cycle, which will help growth to remain in the 6.5, 7% zone for the next few years, despite the global backdrop. So to answer your question, I think February is the best time to do the rate cut.
Okay, actually, yeah. Got it. I just want Rajiv once again. Rajiv, I think another very important announcement has been raising the ceiling on inviting NRI deposits. The ceiling was for 1 to 3 year FCNRB rate could not go above the overnight ARR rate plus 200. Now you can go up to overnight ARR rate plus 400. And likewise, from the 3 to 5 years as well, another 2 percentage points increase in the rates can be given by banks. You expect decent flows, and do you think that's why the rupee also is appreciated?
I think it's been well articulated that the RBI is running a short dollar position in the forward market, and I think it is very keen to attract dollar deposits. But I think the problem currently is that anyway FCNRB rates are well below even the old ceiling, and so therefore to that extent increasing the ceiling at this point in time I don't think will make too much of a difference. What would perhaps have worked is if for the incremental FCNRB some sort of CRR dispensation was given, that would have incentivized the banks to go down this road. But I think this increase in ceiling may not have too much of an impact.
Okay, Kanika, thank you for standing by. Quickly, your key takeaways, and the governor making two very clear statements. One, that growth in the second quarter has bottomed out. He sees an upside with that 6.6% forecast in mind. And on CPI again, after the third quarter, fourth quarter onwards, easing is expected all the way down to 4% by the second quarter. Keeping that in mind, is February your base case as well for a rate cut?
So Ritu, thanks for having me on the show. Yes, February is a base case for us as well. And we are calling for 25 basis points rate cut in Feb and April. We'll ascertain more depending upon how the growth trajectory pans out. See, it's very important to understand just two key takeaways from our side. First, even though growth is recovering in the second half, because 5.4% in Q2 itself had a base effect to it. But from an inflation standpoint, after the 5.8% spike or a higher than expected inflation number from MPC's perspective, the 4.5% growth, 4.5% inflation for the last quarter, in our view, it actually has an element of a downward surprise unless weather shocks materialize significantly. In fact, 42% vegetables inflation in October, if it squares off by March, you can see a downward surprise on inflation, which is exactly why we are calling for that rate cut in Feb. There's only one risk we want to point out to. While the governor just mentioned about global uncertainties, heightened geopolitical risks as well, but we think unless and until dollar volatility stabilizes, the shift in policy may become challenging across central banks in emerging markets, including India. So Fed is a base case, but the risk we want to watch out for is stabilization of dollar, especially after Trump takes office on 28th Jan. Thanks.
No, absolutely. The external environment is one of the key risks to watch out for, especially in January after, like you said, Donald Trump takes over as president. Shobit, thank you again for standing by. Your quick takeaways. Not much of a move again on bonds. Of course, the rupee, we've seen some improvement.
Yeah, hi. I think the key takeaway is the basically adverse growth inflation dynamic forcing RBI to wait and watch. Confirm whether the decline in inflation actually happens and growth actually picks up. So I think these two are the key parameters which RBI would focus on. If indeed growth picks up and inflation comes off, and global developments post Jan 20th are not as disturbing for markets, then perhaps Feb would be live for starting the easing cycle. But in our view, in my view, especially, easing cycle this time around is only 50 basis points. So perhaps if we start in Feb, the next one may not happen in April, but could be pushed out. So, if we are going to see only 2 rate cuts, then the longer they are spread out, the more the benefit could happen in the markets.
All right. Rajiv, that CRR cut last we spoke, you were hoping for, that has been delivered. You said not much move on the lending front yet. Deposit rates have peaked. But what do you make of some of the other measures that have been announced, specifically on the collateral-free agriculture loan limit being raised? What sort of additional credit do you think that would unlock? What do you make of, how significant the move could be?
I think they're all positive moves. It's difficult to estimate. Also, obviously, there will be more, credit that is available to the agricultural sector. But I think what is more important from our perspective as well, our ability to now to meet our PSL requirements, particularly in the small and marginal farmer category, improves, thanks to this. And so therefore, to that extent, this is positive for banks as well.
A lot of commentary, Rajiv, again, from the Reserve Bank of India on these mule accounts. And we've been repeatedly hearing this for the last many, many months. Is there specific directives from the RBI? Are you expecting some regulatory guidelines on this? Could there be some punitive measures in areas where RBI is seeing some issues with regards to too many mule accounts not being handled?
I think the issue, Ritu, is systemic. This is a problem, that all banks are seeing of, fraudsters becoming more and more innovative, being able to open accounts either physically or digitally, sit in the banking system, and then use these accounts to be able to do teaming and lading, etc. So this is a challenge that all banks are currently grappling with. We are working with the RBI and enforcement agencies to see how we can tighten our KYC norms on one side, and to be able to use technology to identify some of these mule accounts and either debit freeze them or actually shut them down as well.
Okay. Well, I guess those efforts would be on anyways between RBI and the banks. But clearly they have upped the ante on this, and this could have a lot of ramifications even for the kind of activities we see in the stock market. I want to come back to the growth story. We have to remember that the Reserve Bank said that the second quarter, the fall in growth has bottomed out, but they have sizably cut the second half forecast from 7.4 originally to 6.8. Now that's a 60 basis point cut in their current quarter forecast. So they have not, the positivity in the third quarter also is not that gung-ho. And then they go on to 7.2, which some may consider ambitious. Upasana, ambitious, you think?
Lata, I'll take it like a H2 versus a H1. And yes, as you mentioned, the quarterly profiling. But if I go by what RBI's estimates are, at 6.6%, the second half of the year is at 7%. Compared to a 6%, compared to a 6% in the backdrop of a 8.2% average last year.
Correct.
So I think that is something which, if you look at, I see a significant downside. Yes, they have revised down significantly their third quarter estimates, but I believe there's further downside to these numbers. I think overall the headline GDP for the full year would be somewhere, we are at 6.1%. With a little bit of, anywhere in between 6 to 6.3% is our range. So I think there is significant amount of downside further to RBI's estimates currently.
Yeah. I mean, we should not have celebrated the 8.2 of last year, because that was a large bit of net taxes which were adding to the GDP. We should have concentrated on the GVA. And even then, the GVA for the last 2 quarters in the previous year were fairly strong. So we are struggling with a big base, even for the current Q4, and therefore 7.2 could be a slightly ambitious number, especially given the headwinds on the external account, more in terms of uncertainty. Though economies are resilient, there is uncertainty as far as the fourth quarter is concerned. when the new government is sworn in the United States. Kanika, now very rapidly, I want both the economists also to comment on the growth number. What would your number be? You think 6.8, 7.2 is ambitious?
So Lata, for second half, we are at around 6.7, 6.8. 7% plus growth number looks difficult, which they've penciled in for the last quarter, given weak credit impulse. And as you talked about, global uncertainty means broad-based private capex recovery is missing. Yes, agri will surprise you on the upside. You can get a 4 to 5% handle there, and government spending pickup will support, but it may not be adequate enough to give a 7% plus growth number, which is why growth is a concern, needs policy stimulus. In fact, we think it should be a combination of fiscal and monetary stimulus.
I just want a brief answer. Okay, Kanika, got it. We have to be brief now. We have to wind up. Kaushik, what's your second half?
Yeah, we have something like 6.8, 6.9. We haven't changed, and our full year forecast is 6.5. Remember that in February, when the data comes out for October, December, it will come out with a lot of revisions of the past data. So it's very possible that FY24, the 8.2% number that you got will be revised down, towards 8%, and suddenly second half might look much better, even if it is statistical.
Yeah. Okay. Yeah. I mean, those are of course imponderables which the Reserve Bank can't work into its model. But even after having brought down its forecast to 6.6, all the three economists over here believe it is perhaps still an ambitious number. That tells you something about the pace of the economy. Finally, Shobit, I wanted to ask you, now that this liquidity is coming in, will CP/CD rates start falling?
Yes, I think because of tight liquidity, there was some upward pressure on the extreme short-end yields. They would be easing. We saw a lot of issuance by banks of CDs recently, and I think there would be definitely some easing on the short end. 3 months to 6 months money market yields would definitely improve from here on.
Okay. Well, gentlemen, thank you very much. Actually, ladies and gentlemen, thank you very much indeed for joining us on this special monetary policy show. The policy has lived up to its importance and the cruciality that it was invested in. A very important CRR cut coming in after 3 or 4 years after it was hiked from 4 to 4.5. It's kind of coming back to status quo ante, and that's going to release 1.16 lakh crore. Exactly what it means is 1.16 lakh crore of the total 230 lakh crore deposits was kept idle. You could not lend it. Now banks can lend it. So that means they will not die for deposits. They will not have to raise deposit rates to attract longer term deposits. Therefore, we can see a bit of a peaking off of deposit rates. For those of us who are savers, that may even be bad news. But for the bankers, it's definitely good. And that's why we are seeing this dramatic jump in the bank nifty and of course in the nifty as well, but the U-turn has really come in the bank nifty. On growth, the Reserve Bank has been much more modest than what it was on October 9th, but there can be a feeling that even 6.6 could be slightly difficult given the kind of slowdown we saw in the second quarter. That's the coverage on the monetary policy coming to you straight from Mint Street. Over to you, Ritu.
Well, thank you, Lata, for summarizing that for us. On that note, we're going to wrap up this special coverage, with the takeaway that given all of what has happened today, perhaps the stage is set for a potential rate cut come February. The risks remain, but largely that is what the market view is centered down to. Thank you very much for tuning in, but stay with us. We'll have to take a short break. On the other side, we'll resume our coverage of other news and updates. So be back in just a jiffy.
After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook. The Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook. The Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC TV18 budget headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen. We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC TV18.
After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook. The Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook. The Monetary Policy Committee decided
Morning, welcome to Trading Hour. I am Reema Tendulkar. With me is Sonal Bhutra. Well, we're counting down to the close of Friday, but also 25 years of CNBC TV18. So we're all set to celebrate, 25 years and the India Business Leader Awards tomorrow. But for the markets, higher for the 6th day in a row. And pretty much they got what they were expecting and wanting. A CRR cut, unchanged repo rates, and markets have moved on. Like the mid-cap index is now up close to about 0.5%. And this week, it's put in a close to a 4% gain.
Oh, yes. And, this is something that, as you said, was expected. Markets got what they wanted, and that's why the kind of reaction. It's a milestone day for us, for sure. A big announcements in the RBI policy meet as well. So, till the time there was no mention of CRR cut that came by, markets saw that sharp dip. That was around 10:30. But the moment we heard about a CRR cut of around 50 basis points, Bank Nifty surged, and that led to the markets going higher as well. For now, we are at the day's high as far as the markets are concerned. Nifty is up 27 points. Mid-caps are outperforming the benchmarks. Bank Nifty is up around 204 points. So the street likes what RBI governor said today. However, the cut in the GDP growth forecast, the higher inflation estimates is something that we need to discuss in greater detail. Of course, we'll get more comments in the press conference that's slated at 12 p.m. today, and you can tune into CNBC-TV18 for all those updates. But let's discuss this and a lot more with Ajay Srivastav, CEO of Dimensions Corporate Fin Services, joining us now. Ajay, good morning. Thank you so much for joining in. Well, the street got what they expected in terms of CRR cut, but there's a slight revision in GDP growth forecast as well. What do you make of the commentary that came by? And is this something that means that February will see the cut finally in terms of rates?
I don't know what February will look like, but certainly for the savers, it's not a good year ending because there were kind of deposit rates they were getting. The banks will kind of put a halt on it for some time. It's not that 1 lakh crore is a very large sum of money for the system, but for the time being, it gives them ability to hold on to the deposit rate which they're doing it. But I would still say that, when you try to, the failure of controlling inflation is hitting the economy everywhere. May not hit the stock market, and I'll tell you why. But the fact remains that you don't control inflation, and it's been a failure. It's been, 3 years now? We haven't been able to go below the 4% target rate, and RBI is saying they will not be able to do that till the next quarter of financial year. It tells you a story for the bottom segment of the population. It tells you a story of why consumption is growing. It tells you a story about the fiscal impact of the tolls which the government are giving out to win elections, because the bottom strata of the society is really feeling the pinch. In stock market, one of the best part of stock market is we are kind of quote unquote unrelated to economy, because so many new companies are coming up in India, the newcomers, which are taking away business of Kirana stores, giving phenomenal returns to us. So many new pharma stories, so many new engineering stories are coming up. So stock market has its own logic, its own way of working. And to an extent, it's kind of an India dealing from the economics. So you had a situation of the growth rate going down and the market going up. Has happened many times in the past, will keep happening here. But bottom line is the fight for controlling inflation has been lost by the Central Bank of India. And I think today was a sad day because I really respect the RBI governor. I really enjoyed all his commentary. Today was the first time I saw the body language down, the shoulders slouching and saying, you know what, I didn't win the war against inflation, and that's going to hurt us.
But maybe he'll have another term, Ajay. We're still getting clarity. We're still awaiting clarity on whether there is a term extension, and he was absolutely quiet on that front.
Well, he can't say, give me extension, can he? Absolutely. And I think it'll be rightfully perhaps to give him extension, but I always am a firm believer, new blood is always good in companies, in government, everywhere. So to that extent, if we have a new governor, maybe a new way to do it, because, you get tired of carrying the burden for some time, and that's time to put it on. He's done a good job. He's gone through COVID. He's done a fantastic job. Lost a fun battle, but kept the economy going. So I think on a whole, one would rate him as quite one of the finer governors RBI has had. But I think inflation is a weak point. And today, when you do the CRR cut, why would you do it? If you're fighting inflation, you want liquidity to be sucked out. So he's got a battle on liquidity. He's got a battle on dollars. You saw the steep 200 or 300 basis point increase in limits of FCNRB deposits up to March 25. That smells desperation for dollar deposits. That smells desperation. Not good for the rupee. Longer term, short term today may be a blip. But the fact remains, I think we are now reaching a point where we need more dollars desperately. So I guess, for a stock market, a lot of mixed things. We're going to go back and analyze what it means for us. But bottom line, what it means for us is we don't want to buy into this market. We want to stay put with what we have invested in, keep some cash on the side. It's going to be tricky as we go down the path of lower and lower growth rates, as most of your economist panel was telling us that RBI, I think, overestimated the growth rate. So keep powder dry for the market. I think you will get chances to buy more, as you just saw 1 month back.
Actually, that was going to be my next question, Ajay, because a lot of economists are expecting downward revision to the growth forecast made by the RBI as well. And as you pointed out, there's a disconnect anyway between stock markets and how the economy is doing. So what are the reasons you think markets will continue to see a downtrend? Is it only inflation? Is it low growth rates? Or do you think generally the FI versus DI debate both will come at par someday, and we will continuously see those flows as well?
See, the problem with FI is that even for Indians, the US market is doing phenomenally well. And they keep doing well. And you saw what happened to crypto last night. Indian investors have not invested too much in crypto for RBI regulations, income tax, and not availability easily. But the ETF opening up crypto ETF in the US just changed the dynamics altogether for global investors. So I think Indian investors would weigh themselves more towards US market, will go towards crypto, will go towards gold, will go towards silver. I think that's one of the things which will keep them going for some time at this point of time. And number two for us is the most important thing is the budget is coming up on February 28th, which will give us a lot of pointers as to where the government's expenditure is going. Because our analysis team has analyzed that the way the dole policy goes on, it'll be almost impossible for government to do a major increase in capex budget and balance the fiscal deficit and still give out those helicopter money of 2,500, 1,000, 3,000, 4,000 per person that every government is announcing. And I just saw in Delhi they announced, AAP said 250 unit. People said, my God, they're giving freebies. Congress just came up and said, give 400 units free. It's a race to the bottom and this is where we see the problem to the economy, that how much money will go towards helicopter money and how much will really go towards generating good quality returns to capital. So we have to digest the results, we digest the budget. So that's why I said, keep powder dry. Where we are invested quite well, everybody's invested quite well. But Nifty 50, that's where the problem sits. Because those companies are heavily dependent on the economy and consumption at the lower end, and they are struggling to perform. So my guess remains that mid-cap will overperform and really do phenomenally well, including new companies, and Nifty 50 will struggle its existence. Some will do well, some will do bad. But Nifty 50 is a problem today in the economy.
Ajay, at the start of 2024, did you anticipate that Nifty would be up 13-15%, mid-caps would be up 27%? Did you expect this kind of a return? And what were your key learnings from the market and the trends that it's taught you for the way forward?
I think, our targets are much higher for our returns, of course. 13-15% doesn't bite us because might as well go buy debt or gold at the end of the day and then stop working. So, so this doesn't excite us. The inflation is 8.5% or 9%, depending what you want to buy. If you want to buy real estate, inflation is 100%. What you could buy last year for 5 crore is 10 crores today. So to that extent, Rima, having 13-15% expectation of return and being in the market doesn't make sense to anybody. You might as well put money in mutual fund and go home and sleep. But expectations are good. They have been met in large way. And I think one of the reasons they have been met is this huge surge of IPOs, and most IPOs have done well. So private placement market, both in terms of unlisted shares, has performed phenomenally well for investors. IPO has done extremely well. In fact, most companies have given, really good returns. And the best part, the new economy companies, the larger ones, they have delivered returns. So, we were confident of what we were doing in the start of the year, keeping away from banks, keeping away from Bank Nifty and focusing on these companies. Few in Nifty, of course, like something like Trent or Indigo perhaps, but that's about it. But the fact remains that the mid-cap story continues to be strong, IPO story continues to be strong, and that is where the returns have come in this year. So no reason to be pessimistic. That's why I said, forget Nifty 50. That's for your grandfathers. You need to focus on the rest of the market. That's where the action is. Let somebody else go spend money on Nifty 50 companies. Maybe one or two good enough, and that's all about it. I was just calculating. You won't believe it. We have exactly 3 companies of Nifty 50 in our portfolio. That's all.
But why even ask grandfathers to invest in Nifty then, right? Everyone should make money if that's the case. But Ajay, thank you so much for joining in today with your thoughts on the markets. Well, that's some fundamental opinion coming in on the markets and the outlook on the sectors as well. We'll slip into a short break. Up next, we'll discuss what's buzzing in the commodities space with Manisha Gupta as always. Stay tuned.
by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook. The Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%. After detailed assessment of the evolving macroeconomic and financial developments and
from sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen. We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18. For 20 years, it has been India's most coveted stage for business leadership. The benchmark of unparalleled excellence.
We have to dream big and even bigger for India.
An accolade that celebrates character, integrity, and decisive action.
You just have to do your best.
Not identified by any single name, nor defined by a single achievement.
The best years are to come, and you don't have to wait for long, it's round the corner.
But redefined every year by visionaries who inspire and legends who lead. A journey that honors those who set the bar higher year after year. This is not just an award, it is a celebration of leadership in action. CNBC-TV18's 20th India Business Leader Awards.
Presented by Standard Chartered in association with Reliance Industries Limited.
After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook. The Monetary Policy Committee decided.
Welcome back. You're still tuned into Trading Hour. It's time to shift focus on the commodity space. Manisha Gupta is joining in now. Manisha, what's the commodity on your radar?
Well, I'm looking at the crude oil prices. The much-awaited important meeting is now done with, and the OPEC and allies on expected lines have said that they will postpone their increase in output, and they would do it only by the first quarter of 2025 now. So that really is what the markets are dealing with right now. Well, apart from that, it also is about OPEC saying that they will also withhold 5.8 million barrels per day for another 4 months now. The street sees this as a spare capacity that the world has at this point in time. It also is about the U.S. crude inventory. inventories, which by the way have declined by 5 million barrels. But when you look at the US production, that is at record highs. And once the new president in US comes in, the expectation is that you could be looking at this number growing further going forward. Well, the US jobless claims data that came in yesterday has been on the positive side, is the reason you've seen dollar index gain up and the US Treasury yields gain up as well. And that's another reason that you have seen pressure come in for prices. For today, it's going to be about the US non-farm payroll data. 200,000 jobs for the month of November is what the street is working with. Anything more than that or less than that is what would give you another reaction coming in for prices.
Thank you very much for that. We will slip into a break on that note. On the other side, we'll invite Suraksha Diagnostic. They listed today. It's been a flat debut. They're largely Kolkata-based companies. So we'll get more details with the top management.
By a majority of 4:2 to keep the policy rate. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook. The Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%.
From sharp insights in the political arena to all the excitement from the world of sports.
We are here at the CNBC-TV18 budget headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
Markets are betting big on affordable housing. You look at the kind of stocks that have risen. We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18. For 20 years, it has been India's most coveted stage for business leadership. The benchmark of unparalleled excellence.
We have to dream big and even bigger for India.
An accolade that celebrates character, integrity, and decisive action.
You just have to do your best.
Not identified by any single name, nor defined by a single achievement.
The best years are to come, and you don't have to wait for long, it's round the corner.
But redefined every year by visionaries who inspire and legends who lead. A journey that honors those who set the bar higher year after year. This is not just an award, it is a celebration of leadership in action. CNBC TV18's 20th India Business Leader Awards.
Presented by Standard Chartered in association with Reliance Industries Limited.
Inflation, on the other hand, surged above the upper tolerance band of 6% in October, driven by a sharp uptick in food inflation. Food inflation pressures are likely to linger in Q3 of the current financial year, and start easing only from the Q4 of the current financial year, that is from January to March. And we expect that this is the trend, and it will be backed by seasonal correction in vegetables prices, Kharif harvest arrivals, likely good Rabi output, and adequate cereal buffer stocks.
Ms. Ritu Mittal, who is also the promoter, joint MD and CEO, join us on the show now to talk about the way forward. Thank you very much and congratulations. This is Rima here. We had spoken earlier on IPO KYC. So, now that you're listed, and for the benefit of all the new shareholders who believe in the Suraksha story, take us through what they should expect on growth and margins going forward. Give us a near-term outlook, 1 year, and even over the next 5 years. How will Suraksha Diagnostics as a company evolve from here on? Dr. Chatterjee, if you would like to go first.
Regarding the growth story, it is going to be extremely robust. As our CEO will explain it to you, that there has been extensive plans for growing the chain forward in the next 3 years. Ritu, you pick up.
So, diagnostics is a regional play, and it's a trust-based business. Therefore, we would first like to expand throughout West Bengal and then enter the neighboring states of Northeast, followed by Bihar, Jharkhand, and Orissa. That's the plan going forward. We do intend to put up 12 to 15 centers every year. As far as the margins are concerned, as demonstrated by our peers, it's just going to get better as operational efficiency sets in and we get the operational leverage.
So how long does it take for a new diagnostic? Yes, please go ahead.
Historically, it has been seen that with the growth of the number of centers that you have, there is a remarkable increase in the turnover of the company as it goes. So, with a robust plan of growth, we can expect better than market CAGR that is currently available.
Okay. So, the earlier conversation that you had indicated that margins will improve to around 40 to 42% versus current 35%. How soon do you think you can get to that mark, and what would the drivers of that margin expansion be? You spoke about, of course, the additions in terms of diagnostic centers that there are. Will there be any other factors other than store addition? Will you see price hikes as well? How often does it happen, since it's a regional play, but it's a competitive market as well?
So historically, Suraksha has been increasing prices at about 3 to 4% every alternate year, and we would continue to do so. As far as the margins are concerned, it is basically coming out of expansion, because as your base grows, your margins just improve because your fixed costs get divided. And we are also planning to add a lot of tests, high-end tests, to our portfolio, which will again contribute to revenue and also margins in the Eastern India zone.
There are these high-end tests which we call esoterics, and Suraksha today is the only lab performing most of the esoterics. And on top of that, it plans to expand the menu to a complete one in the next 3 to 4 months. So we believe that as we add the esoteric component in our menu, the profitability, because these being high-end tests, the profitability will rise considerably because of this.
Ritu, since you all have aggressive expansion plans, you spoke about 12 to 15 centers being added every year. I remember from our earlier conversation, even an acquisition was something that you were open to and looking at. So how are you planning to fund all this? Because in the IPO, you all have only done an offer for sale.
So we have cash accruals in the book, and the company is cash rich. There's hardly any debt in the balance sheet. So we typically plan to go through accruals that the company has. And if required, if we get an acquisition which we find worthwhile, we can definitely raise debt for the same.
Okay. What would that acquisition kitty be? What's the cash in the books right now? Is there something that you already have your eye on and we could hear about it, say, in this fiscal or the next calendar year?
So cash in the books is around 50 crores. And maybe you will hear about some acquisition in the next fiscal year.
Okay. You mean in FY26, not before the close of this fiscal year, which is March 2025?
We will definitely try to bring a closure to it.
Okay.
But since we have all been involved in this IPO process, things have got a bit delayed, but it will be sooner than expected, the acquisition that we are talking about.
Sir, since you have an eye on a target clearly, the one that you're referring to, will it require you to go out there and raise debt? Is it a large acquisition, or will your internal accruals be sufficient?
No, it is not a large acquisition, but it is a very niche acquisition. So we will not need to raise any debt because of it. But this niche emerging field of medicine will give impetus to a very large growth in the whole ecosystem of Shuroka.
Okay, all right. So, Ms. Mittal, I wanted to understand the current market share that you have in West Bengal, and if you're looking at other eastern states as well, what kind of capex will you put in for that?
So we planned a capex outlay of around 70 crores every year going forward for the next 3 to 4 years. And the market share that Suraksha today has for East India is around 1.3%. But again, East India is a huge territory and Suraksha is present in a very small part of it. If we were to consider our market share in territories where we are heavily present, it would definitely be upwards of 10%.
Thank you. Thank you, Dr. Chatterjee and Ms. Mittal for joining in, and wish you all the best and look forward to more conversations with CNBC TV18. We will slip into a break on that note with the news that things are still very quiet, at least on the Nifty and the Sensex. Marginal red, but the mid-caps are holding up in the green. On the other side of the break is our special segment, Fin Street. We'll put the spotlight on how banks have performed in the second quarter.
Weaknesses in the manufacturing sector, however, was not broad-based, but was limited to specific sectors such as petroleum products, iron and steel, and cement. Going forward, high-frequency indicators available so far suggest that the slowdown in domestic economic activity bottomed out in the second quarter of this year, and it has since recovered, aided by strong festive demand and pickup in rural activities. Agricultural growth is supported by healthy kharif crop production, higher reservoir levels, and better rabi sowing. Industrial activity is expected to normalize and recover from the lows of the previous quarter. Now, even as liquidity in the banking system remains adequate, system liquidity may tighten in the coming months due to tax outflows, increase in currency in circulation, and volatility in capital flows. To ease the potential liquidity stress, it has now been decided to reduce the cash reserve ratio, that is, to reduce the CRR of all banks to 4%. Of net demand and time liabilities, that is NDTL, And this will be done in two tranches, two equal tranches of 25 basis points each, with effect from the fortnight beginning December 14th and December 28th.
CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook. The Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at...
Banks have performed the second quarter of FY25.
Post Q4 FY24 results, CNBC-TV18 did mention that net interest margin of lenders can come under pressure, credit cost will rise, and asset quality will also deteriorate owing to normalization. So what has happened? Net interest margin of the lenders continue to remain under pressure for last 2 quarters in a row. Credit cost is rising. Some banks have even raised their FY25 credit cost guidance in this quarter. Pain has continued, especially for lenders having exposure to rural market like microfinance loans, and now even for lenders having exposure to unsecured retail loans. So PSU banks, their net interest income saw decline on a sequential basis for second quarter in a row. Private banks, their NI growth was around 1% on a sequential basis, led by high-yielding retail loans. Tamil Nadu Mercantile Bank, Union Bank of India saw YOY and quarter-on-quarter decline in their net interest income in Q2 FY25. Dhanlaxmi Bank is perhaps the only lender to see YOY decline in its net interest income for third quarter in a row. Now, calculation shows that sequentially net interest margin might have declined by 10 basis points for PSU banks and by about 9 basis points for private banks. So overall, net interest margin has declined sequentially for all the lenders by roughly about 10 basis points. Operating profits grew slower for private banks versus PSU banks. PSU banks' operating profit growth was led by robust treasury gains that they had in Q2 FY25. Overall, operating profits grew by 19.5% YOY and close to 7% sequentially. In this, the operating profits of PSU banks grew by 11% quarter-on-quarter, and that of private banks grew by nearly 2.7% on a sequential basis. Operating profits declined YOY and quarter-on-quarter for lenders like ISAF SFB, Karnataka Bank, IndusInd Bank, and Ujjivan Small Finance Bank. 11 out of 39 lenders saw their operating profits decline on a sequential basis. Now, banking sector has reported their highest ever quarterly PAT. So, PSU Bank's PAT growth was robust on account of the fact that they had treasury gains and lower provisioning in this quarter. PAT of private banks was impacted from credit cost or elevated provisioning on unsecured retail loans and MFI loans which slipped into slippages. Overall, banking sector's PAT grew by nearly 3.5% quarter-on-quarter. ESAF SFB is perhaps the only lender to report net loss in Q2 FY25. Now, PAT declined YOY and quarter-on-quarter for lenders like Equitas, IDFC Bank, Utkarsh Small Finance Bank, IndusInd, Ujjivan, RBL as well as Suryodaya Small Finance Bank. 11 lenders saw their earnings decline on a sequential basis. Let's take a look at the asset quality, which has been the best ever for the entire sector. Now, private bank slippages increased substantially when compared to that of PSU banks. Private banks' quarterly slippages increased by 2.7% quarter-on-quarter when compared to a decline of nearly 3.5% for PSU banks. Overall, slippages declined by 0.1% quarter-on-quarter for the entire banking sector. Now, slippage ratio remained healthy or below 1.3% in Q2 FY25. Slippages were elevated for players, especially in the microfinance and unsecured retail credit like ESAF, Utkarsh, Equitas, Suryodaya, etc. Asset quality of the banking sector is the best that you are seeing in last 10 years or even more. And if you take a look quarter-on-quarter, the net NPA ratio or the net NPA has increased for private banks for second quarter in a row. Interestingly, the net NPA ratio difference between PSU banks and private banks is only 11 basis points, which is the lowest ever in last decade or even more. In terms of outlook, let's take a look at what analysts and lenders have to say. While lenders would focus on protecting themselves from increasing credit costs, the loan growth for majority of them may take a backseat. Net interest margin may struggle in the near future. Credit costs seen elevated for some players, especially in the near term. Now, the gap between deposit growth and loan growth will continue to narrow. OPEX will be a key monitor to manage profitability in this tough cycle. Peak profitability is behind and valuation is inexpensive, which means that it is largely priced in. PSU banks have outperformed private banks on certain parameters like operating profits, profit after tax, slippages, as well as asset quality. So in Q2 FY25, laziness got paid off while aggression saw some pain.
Okay, thanks Abhishek for that. We will slip into a break on that note. We'll come back with more on the market.
Welcome back. You're still tuned into Trading Hour. Well, some decline from the highs. The Nifty is down 36 points. Bank Nifty too has come in for some profit booking. Mid-caps are outperforming, yes, but that index also is up just 130 points. So there's a definite volatility that is the flavor of the markets right now. But we'll keep tracking that for you. For now, we have to slip into a break. When we come back, we'll talk about more stock-specific action. Stay tuned for that.
.75%.
From sharp insights in the political arena to all the excitement from the world of sports.
We are here at the CNBC-TV18 Budget Headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen. We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18. For 20 years, it has been India's most coveted stage for business leadership. The benchmark of unparalleled excellence.
We have to dream big and even bigger for India.
An accolade that celebrates character, integrity, and decisive action.
You just have to do your best.
Not identified by any single name, nor defined by a single achievement.
The best years are to come, and you don't have to wait for long, it's round the corner.
But redefined every year by visionaries who inspire and legends who lead. A A journey that honors those who set the bar higher year after year. This is not just an award, it is a celebration of leadership in action. CNBC TV18's 20th India Business Leader Awards.
Presented by Standard Chartered in association with Reliance Industries Limited.
Inflation, on the other hand, surged above the upper tolerance band of 6% in October, driven by a sharp uptick in food inflation. Food inflation pressures are likely to linger in Q3 of the current financial year and start easing only from the Q4 of the current financial year, that is from January to March. And we expect that this is the trend and it will be backed by seasonal correction in vegetables prices, Kharif harvest arrivals, likely good Rabi output and adequate cereal buffer stocks. The weaknesses in the manufacturing sector, however, was not broad-based but was limited to specific sectors such as petroleum products, iron and steel, and cement. Going forward, high-frequency indicators available so far suggest that the slowdown in domestic economic activity bottomed out in the second quarter of this year, and it has since recovered, aided by strong festive demand and pickup in rural activities. Agricultural growth is supported by healthy Kharif crop production, higher reservoir levels, and better Rabi sowing. Industrial activity is expected to normalize and recover from the lows of the previous quarter. Now, even as liquidity in the banking system remains adequate, system liquidity may tighten in the coming months due to tax outflows, increase in currency in circulation, and volatility in capital flows. To ease the potential liquidity stress, it has now been decided to reduce the cash reserve ratio, that is, to reduce the CRR of all banks to 4%. Of net demand and time liabilities, that is NDTL, and this will be done in two equal tranches of 25 basis points each, with effect from the fortnight beginning December 14th and December 28th.
CNBC TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon
see two-way swings on mixed global and domestic cues. Even though RBI's bank liquidity boost is seen as a welcome step, consumer durables and utilities eke out gains while IT and realty drag. RBI defers a rate cut, keeping a prudent eye on global developments and the growth inflation dynamic, even as it marks up its inflation expectation for FY25 to 4.8% from 4.5% earlier. Economists bet on a rate cut in February. RBI cuts the cash reserve ratio for banks by 50 basis points, boosting liquidity in the banking system by rupees 1.16 lakh crore rupees. The bankers see deposit rates peaking out following this, but bank margins could improve only by 3 to 5 basis points. RBI revises its GDP growth outlook for FY25 to 6.6% from 7.2% earlier, following the sharp dip in the second quarter numbers, even as it remains hopeful for a correction in the second half on the back of revival in cement, steel and power sectors. RBI raises the cap on collateral-free agriculture loans to rupees 2 lakh from rupees 1.6 lakhs earlier per borrower to increase the price of agri-inputs. To account for the increase in prices of agriculture inputs, the move is aimed at easing bank credit access to the needy farmers. Hello and welcome to Halftime Report. I'm Ritu Singh. The Reserve Bank of India's policy has been our focus this morning. No repo rate cut, but a cash reserve ratio cut of 50 basis points has been announced, bringing down the CRR to 4% for banks in two tranches in the 2 fortnights of December, which is expected to release about 1.16 lakh crores of liquidity for the banking system. That is seen as a positive. The GDP has been revised downwards for the current forecast. For the current fiscal, the forecast has been brought down to about 6.6%, and the inflation forecast has been raised. But the focus is on the 50 basis point cut on the cash reserve ratio, largely expected by the street. Abhishek Kothari is joining us to tell us what brokerages are making of what the likely impact on banks is going to be like.
Well, Citi had written a note a couple of days back with respect to a potential CRR cut and what it would mean for banks. So they say that the implication of potential CRR cut has and improved prospects of repo rate reduction is seen ahead. So durable liquidity has reduced to more than rupees 2 lakh crore in just 1 month because of substantial forex operations that has been done by RBI. So a reduction in CRR, that is cash reserve ratio, from 4.5% to pre-COVID levels of 4%, and would release more than rupees 1 lakh crore into the system. So we have RBI mentioning that it would release about 1.16 lakh crore into the system. So CRR cut can be viewed favorable for HDFC Bank, Axis Bank, Federal Bank and Bank of Baroda. In their assessment, this release of CRR by 50 basis point would augur only about 2 to 3 basis point with respect to net interest margin. And we also had, one of the bankers today mentioning that this CRR boost would, lead to net interest margin improving by 3 to 5 basis points. So anywhere between 2 to 5 basis point is the net interest margin improvement that is seen. But we are in a rising credit cost scenario. So in that, how much would that transfer into ROA needs to be seen, because credit cost is also inching up for majority of the lenders. Back to you.
All right, so 2 to 5 basis point improvement in margins as a result of that cash reserve ratio cut by 50 basis points to 4% of NDTL. That was the big headline of today's policy, where the repo rate, of course, was left unchanged. We have the top brass at the Reserve Bank of India sitting down to address the media after announcing the policy decision earlier today. The RBI Governor Shaktikanta Das, flanked by the deputy governors on either sides, about to start that press conference. Lots of questions, of course, on the growth forecast as well. A lot of economists on a panel earlier were alluding to the fact that perhaps the second half forecast is a tad optimistic, getting to 7% plus kind of a number in the fourth quarter. That is something that a lot of the economists were raising questions on. But for now, it looks like we're set for a potential rate cut finally after a 2-year gap in the February policy. Lots of questions for the governor, lots of questions on the action taken, on the CRR front. All of that will be addressed in this press conference that is about to start. Let's take a look at what they're saying.
Welcome to this post-monetary policy press conference. Friends, we have with us Governor, Reserve Bank of India, Shri Shaktikanta Das, Deputy Governor, Dr. M.D. Patra, Shri M. Rajeshwar Rao, Shri T. Ravi Shankar, and Shri Swaminathan J. We also have with us Dr. O.P. Mal, Executive Director, and Executive Director Dr. Rajiv Ranjan, and other colleagues from Reserve Bank. Sir, to begin with, I would request you to make your opening remarks. After that, we'll have the Q&A, please.
I would like to, in the beginning, make five observations. First, number one, the MPC remains committed to restoring the balance between inflation and growth, which has got unsettled recently. Two, the Reserve Bank will use its various policy instruments to create the conditions for restoring the inflation growth balance. Three, the credibility of the flexible inflation targeting framework needs to be preserved. Four, inflation has to be brought down in the interest of sustainable growth. Five, prudence, practicality, and timing. I repeat, prudence, practicality, and timing will continue to be the guiding principles for the Reserve Bank's future actions. It is all about dissection of the inflation growth conditions and acting accordingly. Timing of actions is the key. Thank you.
Thank you, sir. Before we begin, I'll request the media friends present here to wait for their turn. You may see my colleagues on the aisle. They have the mics with them, so they'll give you the mics, and please speak in the mic because otherwise you'll not be audible to outsiders. And in the interest of time, as I always say, please restrict to one question per person, and if time permits, we can consider the other one. Sir, there are 24 participants from media today, and with your kind permission, I'll start calling out their names. So I'll start with Mr. Yogesh from Doordarshan.
Good afternoon, sir. Thank you for the opportunity. Sir, despite the reduction in the GDP forecast, the rates are basically maintained. The status quo is maintained, but the CRR was reduced by 50 basis points. What is the thinking behind that? Thank you.
I think I have explained it elaborately in the statement which I presented earlier today morning. And as regards growth, the second half of this year looks better than the first half. The first quarter of this year, there were issues of, that coincided with the election season, countrywide election. Probably that affected in particularly government expenditure. Second quarter, the reasons for the slowdown we have explained. Monsoon, continuing monsoon rainfall also affected activities, particularly in mining, in electricity demand. Manufacturing also was slow. So I have explained why we expect the second half to be better this year, better than the first half. And on inflation, I have also given a path, we have also given a roadmap. So we need more credible evidence that things are happening the way we are expecting. That the direction of developments, the direction of evolving conditions, the outlook is playing out in line with our expectations. And then, as I have just now mentioned, it's a question of timing. You have to appropriately time your actions. When there is a time for a particular action, be it rate cut, be it liquidity action, be it whatever is the action, they have to be well timed. They have to be timed in a manner keeping the outlook in mind, and also Action has to be taken when it is really going to be most effective and impactful.
Thank you, sir. Next, we'll have Mr. Manojit Saha from Business Standard.
Thank you, sir. Let me ask something which is there in everybody's mind. Have you heard anything from the government so far, whether you are continuing this term, at least informally, before the policy meeting started? I will have one more question today. Yes.
Is that your only question?
No, I will have one more.
No. Let's stick to monetary policy. Please ask your question on monetary policy. Otherwise, you will miss your chance on asking a question on the monetary policy. So you choose which one you want to ask.
Okay, since
it's your choice.
Okay.
I'm willing to answer the first question also, but it's your choice.
Okay, please answer the first question then.
Okay, I'm not giving you any headline, and I think it's better we stick to monetary policy. Thank you.
Thank you.
Thank you,
but
sir.
you can ask your main question, please.
The question I wanted to ask also is, how did you get the growth estimate so wrong for the Q2? You know, you projected 7% even in October. It came out at 5.4%. So what exactly went wrong in the projection?
I would request Deputy Governor Michael Patra to take that question.
There is a lot of commentary on that already in the press. If you look at the demand side, the main problem is investment. On the supply side, the main problem is manufacturing, and the two are intertwined. In the manufacturing, the biggest issue is the slump in the sales growth, and that is reflecting inflation hitting the urban consumer. So when sales growth is down, companies do not want to invest in new assets because they see demand as moderate, and it can be met from existing capacity. Since they don't want to engage in new capacity creation, investment is down. So the underlying slowdown in growth is because of inflation.
Thank you, sir. I'll now request Mr. Ankur Mishra from ET Now.
Good afternoon, Governor. I want to understand the inflation scenario which you have explained. You are also maintaining that in Q4 the situation might be slightly better, while in Q3 the upper side risk remains. Last time you had mentioned about the horse bringing back to stable. What is the scenario now? Is it the scenario that a controlled trot may continue, or you see that you need tighter reins to control the horse?
The horse has made a very valiant effort to bolt. Our effort is to keep it in tight leash.
Thank you, sir. May I now ask Mr. Vishwanath Nair from NDTV Profit?
Good afternoon, Governor. The first question is, you mentioned that if growth continues to linger lower, then you may need policy support. You're admitting that Q2 was looking weaker, even though the rest of the financial year may look better. Your cut on the growth projections is sharper than your hike on inflation projections. I still want to understand why then the status quo, because it's clear that you have a growth bias in your commentary.
No, whether I have a growth bias or inflation bias, I think it's for you to interpret. But if you recall, before I presented my statement, I made some extempore opening remarks where I have exactly explained our approach. Why monetary policy is important, what exactly is the mandate given to the Reserve Bank. In the Reserve Bank of India Act, the provision is very clear. And our effort is always to follow the legal provision, the mandate given to us, both with regard to inflation and growth. Our effort is to follow it in letter and spirit. There is no, in the life of a central bank, there is no scope, there is no room for knee-jerk reaction. We need more credible evidence. We need more evidence with regard to how the outlook is likely to be, and based on that assessment, the effort is always to take action in time. Whatever action, I'm not talking about rate cut or again, but whatever action we take, it has to be well timed, and it depends on the outlook. No room for knee-jerk reaction. because you take a certain knee-jerk reaction which you may have to reverse. So you should not, one should not regret, but let me tell you very clearly that our effort has always been to remain in line with the curve, never fall behind the curve, and I think we are maintaining that trend.
Thank you, sir. अब मैं जी बिजनेस से श्री ब्रजेश कुमार से आग्रह करूंगा.
सर, जैसा कि हर बार यही होता है कि इन्फ्लेशन को लेकर जो चिंता होती है कि फूड इन्फ्लेशन एक बड़ा कंपोनेंट होता है जो चीजों को डिस्टर्ब करता है आपकी टारगेटिंग को. एक डिबेट ये भी थी इकोनॉमिक सर्वे में कि क्या फूड इन्फ्लेशन का कंपोनेंट हटाकर फिर टारगेटिंग को देखा जाए. तो इस पर सवाल ये है कि क्या सप्लाई साइड को दुरुस्त करने के लिए सरकार से आपकी किस तरह की कम्युनिकेशन हाल फिलहाल में हुई है कि ये चीज ठीक हो, और जो इकोनॉमिक सर्वे का एक व्यू था कि फूड इन्फ्लेशन को हटाकर टारगेटिंग की जाए, उसको लेकर कोई बात?
इसी सरकार के साथ हमारा क्या डिस्कशंस होता है मैं आपके साथ शेयर नहीं करना चाहता हूं, लेकिन आपको ये कहना चाहता हूं रेगुलरली हम सरकार के साथ डिस्कशन में रहते हैं इन्फ्लेशन को लेकर, और सप्लाई साइड मेजर्स के बारे में काफी इंटरनल डिस्कशन रहता है, तो उसके बारे में मैं बाहर कुछ बोलना नहीं चाहता हूं. और जहां तक आपने इन्फ्लेशन टारगेटिंग फ्रेमवर्क और फूड इन्फ्लेशन की बात आपने वो सवाल उठाई, मैं आपका ध्यान आकर्षित करना चाहता हूं कि शायद अगस्त पॉलिसी में मैंने विस्तृत रूप में एक्सप्लेन किया था कि हेडलाइन क्यों टारगेट होना चाहिए और फूड इन्फ्लेशन को हम लोग क्यों इग्नोर ना करना चाहिए. रिजर्व बैंक ऑफ इंडिया एक्ट में जो प्रोविजन है उसके अनुसार हेडलाइन इन्फ्लेशन हमारा टारगेट है. हम अपने मर्जी से कभी कोर इन्फ्लेशन को टारगेट नहीं बना सकते हैं, कभी फूड इन्फ्लेशन को टारगेट नहीं बना सकते, कभी फ्यूल इन्फ्लेशन को टारगेट नहीं बना सकते. वो जो है वो लॉ में, रिजर्व बैंक ऑफ इंडिया एक्ट में लिखित रूप में है, उसको हम फॉलो करना चाहिए. और हमारे पास वो मतलब ये डिस्क्रिशन नहीं है कि हम अपने मर्जी से कभी इसके ऊपर कभी उसके ऊपर ध्यान दें. जो लॉ है उसको हम फॉलो करते हैं. थैंक यू.
धन्यवाद सर. नेक्स्ट विल बी मिस लता फ्रॉम CNBC.
Thank you, Bunny. Sir, you couple of times you have said that the growth inflation balance has gotten skewed and you have to restore the balance. Does it mean you were skewed in favor of growth and you're going back to inflation, or was the balance skewed in favor of inflation and now it will become pro-growth? How do we understand this skew question? And just a word on CRR, is that is only going to take care of the liquidity that has already gone away from the system. Q4, we are still staring at, cash withdrawals, possible dollar inflows and RBI dollar sales. So, do you still have OMOs or any such thing on the table?
You see, whatever action we have on the table, I will not be able to spell out. It will depend on how the situation evolves. We expect in the next few months, we expect tight liquidity for reasons which I have explained. One is that we expect the tax-related outflows from the system, both direct tax in the middle of December and thereafter the GST. Together with that, there is a possibility of likelihood of increase in currency in circulation because the busy credit season, agricultural activity has now picked up and that requires cash. That will merge into the harvest season also, which requires cash. So the currency in circulation is also likely to go up. And then there have been a significant amount of capital outflows in the months of October and November. That is, outflow of forex has happened because of FPIs exiting. So therefore, with regard to your point about dollar inflows, that is something which is difficult to quantify at the moment. Our assessment is that liquidity conditions will remain tight. And let us also let's also bear in mind the fact that the CRR increase was done sometime, I think if I remember correctly, in April 2020. In April 2022, I think in that policy we did it. It was a temporary measure. It has served its purpose.
it was time to normalize it. And with regard to growth inflation balance, I didn't say skewed, I just said unsettled. And I think in the statement I have used a different word. So basically what we mean is that last time we had said that growth inflation balance is well poised. Well poised means the growth looked good for that quarter as well as for the whole year. Inflation outlook also, we were aware that September and October inflation prints will be higher. But as you know, September and October, because of weather factor and other factors, weather factor and other factors, food inflation went up very steeply. September numbers were broadly a little higher than what we had estimated. October also we had expected it to be high, but the actual number came a little higher than what we had estimated. So therefore inflation, was more than what we had expected, little more. And growth also has moderated. The numbers are, we have spoken, we have given the numbers. So the well-poised character of the dynamics between growth and inflation, that has got somewhat unsettled. Our effort is now to restore that balance, which basically means that we want inflation to be brought down closer to the target. We want growth also to pick up, and I think our estimates, our assessment also shows that growth is, is picking up. So we have to be very watchful. We have to maintain that, that balance between growth and inflation, and that's it. Thank you.
Thank you, sir. Next, we'll have Mr. Mayur Shetty from the Times of India.
Thank you, sir. My original question was on this GDP coming as a surprise, but Manojji's already asked that. My other question is on, during your term, there have been a couple of crises, and RBI has coordinated with the government at that time, and that has worked very well, the coordination. So now that uncertainty is constant, do you think there is scope for continuing this coordination, given that, like you said, the inflation mandate is enshrined, and there is an expectation from the government that there should be a focus on growth, and also you all do not give any forward guidance on your actions. So, do you think there's any forward guidance on your actions, like so? Do you think there's more scope for coordination?
No, I think coordination has been there, coordination is there, and coordination will continue to be there. So that is a constant process, and it continues. And whenever we have any thoughts or any concerns, we always share it with the government. That engagement and coordination continues. In fact, in one of my recent speeches in an international seminar which we organized in Mumbai with the participation of, I think, the central bank governors from the south, I had highlighted the importance of fiscal monetary coordination. So that is very important. It has proved its mettle, it has proved its strength during the stressful times of COVID, and thereafter when the Ukraine war started and inflation suddenly spiked. So coordination continues.
Thank you, sir. Next we'll have Ms. Swati from Reuters.
Thank you, sir. So we've seen growth numbers come down sharply. The 5.4% was a shocker. You also revised down your growth estimates for the next 2 quarters, whereas inflation is high. Is it fair to say that India is now in a stagflationary phase? And also looking at these growth numbers, is the trend growth for India coming down from the 7.5-8% levels closer to 6.5? Is the trend growth for India much lower than what we have been talking about?
I will pass on this question to Deputy Governor Michael Patra, but I would also suggest that, there have been so many other announcements, some very important announcements in the, in the part B of as part of our additional measures. So I think maybe some questions on that would be useful, for the wider audience which is watching this, this press conference. Go ahead.
So I explained why there is a slowdown in GDP growth in the second quarter due to a special set of factors. Now, it's not, I think, appropriate to make a judgment on the trend rate on one data point. So what was expressed as 8% was not a trend. It was just the average from 21 to 24. And all over the world, for every country, the projections that are being made for 25 and 26 are implicitly correcting cyclically for the rebound from the pandemic for all countries in the world. So even when we made our initial projections, they were not at 8%, they were 7.2%. And also in the monetary policy report, we gave a projection for 26, which was the same cyclical correction. After which, after this correction is over, it will revert back to a trend, and we are yet to see the data points of that trend. What the governor has been saying is that the average between 21 to 24 was 8%. Now, if you see the second half of the year's projections, there is a reversion back towards an upper rate of growth, 6.9, 7.3, and that continues into 26. So we are hopeful that we will reach that level again.
Thank you, sirs. Next, we'll have Ms. Hamsini Kartak from Money Control.
Hi. What exactly was the rationale for reducing CRR? The question here is in the context of, in absolute terms, we don't have a liquidity deficit as such. And if I were to look at it from a banking perspective, I would think that a CRR cut would allow banks to ensure that they don't have to compromise much on margin versus a repo rate cut at this point in time, given that profitability of banks has also sort of been under the weather for the last 3-4 quarters. Was that also a thought process that you had in your mind when you initiated the CRR cut? And as such, the bank lending is also anemic. So do you believe that this will spur up or free up some more money for them to lend, increase the lending?
You see, the CRR cut I have just explained a little while ago, we have normalized it. And it was time to normalize. It was a temporary measure, so we have normalized it. What the banks do with the CRR money is entirely their call. Whether they use it for giving credit or whatever purpose they want to use, it is their call. And with regard to liquidity, it is surplus today. It is surplus today, perhaps on Monday, next week also 2-3 days it is likely to be surplus. But we clearly see that, we are going into a phase where liquidity is going to be very tight in the latter part of this month, December, and continuing into January and perhaps, into February. So we thought it was time to sort of normalize the CRR levels. And the other questions which you mentioned about, banks, some other these things, we don't make monetary policy or liquidity decisions keeping in mind the balance sheet requirements of banks. Our policies are governed by the growth inflation dynamics. Our policies are governed from the point of view of maintaining overall stability of the economy. Whatever issues are there in the banks, etc., that is dealt with through the supervisory arm of the Reserve Bank.
Thank you, sir. Next, I'll ask Mr. Ashish Agashe.
Thank you, sir. What prompted the FCNR-B measure, sir? Last time we saw upwards of $30 billion coming in after some relaxations. This time is there some bit of idea of how much incremental money would flow in? What are your expectations?
These measures are intended to enhance the capital flows, and that has been clearly articulated in the circular. There is a scope for foreign non-resident Indians or eligible Indians who are eligible to invest into the FCNR-B to increase their deposit base in India, and that is purely what has been contemplated at this point in time.
And it's a temporary measure, which is there till 31st March.
थैंक यू सर. अब मैं ईटी नौ स्वदेश के श्री अनुराग शाह को आमंत्रित करूंगा.
धन्यवाद पुनीत सर, सवाल पूछने का मौका दें. सर, इन दिनों चर्चा में है कि जो बैंकों के द्वारा इंश्योरेंस का कारोबार किया जा रहा है, उसको लेकर वित्त मंत्री ने भी हिदायत दी है और हमने देखा है कि कुछ प्राइवेट बैंक, सरकारी बैंक जो है इंश्योरेंस कंपनियों में हिस्सा खरीद रहे हैं. तो वहां पर कुछ मामलों में आरबीआई मंजूरी देता है, कुछ में नहीं देता है, और कई सारी जो इंश्योरेंस कंपनियां वहां पे बैंकों का 50% तक भी हिस्सा है. तो क्या आरबीआई केस बाय केसेस पे ही वो हिस्सा मंजूर करता है या फिर कुछ नियमों में बदलाव किया है? और दूसरी तरफ जहां पर देश में इंश्योरेंस का पेनिट्रेशन बढ़ाना है और बैंकों की बड़ी भूमिका बड़ी भूमिका है इंश्योरेंस के पेनिट्रेशन में, लेकिन कोई कंपनी जो काफी बड़ी है, जो जिसको कोई बैंक नहीं खरीद सकता, वहां पर रिजर्व बैंक की तरफ से केवल टेम्परेरी मंजूरी दी जाती है बैंक में हिस्सा खरीदने पे। तो क्या उन नियमों में कुछ अभी बदलाव किया है? और सर, अभी जो आपने अपने स्टेटमेंट में बताया कि अब पॉडकास्ट शुरू करने वाले, कम्युनिकेशन का भी नई स्ट्रेटजी होगी, तो उसका क्या मकसद है, किस ऑडियंस को टारगेट कर रहे हैं?
आपने बहुत सारे क्वेश्चंस पूछ लिए। मैं फर्स्ट
नहीं तो वो पॉडकास्ट वाली नई इंटरेस्टिंग चीज
नहीं बस वही तो मैं कह रहा था। बाकी चीजों के बारे में भी सवाल पूछना जरूरी है। आप डिप्टी गवर्नर राजेश्वर राव जी इसके बारे में रिप्लाई देंगे।
आपने जो आपने इंश्योरेंस के बारे में पूछा था, फॉर्म्स ऑफ बिजनेस के बारे में हमने एक ड्राफ्ट सर्कुलर पुट आउट किया है, जिसमें व्हाट इज द परसेंटेज ऑफ होल्डिंग व्हाट टाइप ऑफ बिजनेस जहां पे बैंक्स इन्वेस्ट कर सकते हैं उसके बारे में लिखा है। तो उसके आधार पर फ्यूचर एक्शंस विल बी टेकन और रेगुलेटरी एक्शंस विल बी टेकन ऑन दैट बेसिस। तो वी आर वेटिंग फॉर फीडबैक ऑन द फॉर्म्स ऑफ बिजनेस सर्कुलर एंड दैट विल गाइड अस इन द वे वी लुक एट इन्वेस्टमेंट्स इनटू सब्सिडियरीज और एसोसिएट कंपनीज ऑफ बैंक्स।
मंत्री ने बैंकों को हिदायत दी है, तो आपने भी जो मिस सेलिंग हो रही है प्लेटफॉर्म पे उसको लेकर कुछ
नहीं, इसके बारे में हमारा ऑलरेडी एग्जिस्टिंग इंस्ट्रक्शंस है। देयर आर क्लियर इंस्ट्रक्शंस जो हमारा बैंकों के लिए जो डायरेक्शंस या इंस्ट्रक्शंस कुछ भी कहिए वो ऑलरेडी एग्जिस्टिंग है, उसमें कुछ नए करने की जरूरत नहीं है। लेकिन हमारे सुपरविजन के द्वारा हम ये चेक करते हैं जहां पे जो अपना आरबीआई इंस्ट्रक्शन से डिविएशन होता है उसमें हम कार्रवाई करते हैं। देखिए, पॉडकास्ट एक न्यू इंस्ट्रूमेंट है, इट्स बिकम वेरी पॉपुलर नाउ एंड आई थिंक व्यूअरशिप स्पेशली जो है यंगस्टर्स में बहुत वाइड है। तो इसीलिए आरबीआई हम वी वांट टू रिमेन इन टाइम्स रिक्वायरमेंट ऑफ द टाइम्स। कहीं इसमें वी इन दिस मैटर ऑल्सो वी शुड बी अहेड ऑफ द कर्व। सो it's basically a communication tool to communicate with wider cross section of the people. There is sometimes it may be necessary not to give a detailed interview. Sometimes it may be necessary not to do a press conference. You want to talk on a particular issue. Some new measure has been announced that needs to be explained to the people. Podcast will help in those kind of things.
Dhanyawad, sir. Next, we'll have Mr. Anup Roy from Bloomberg.
Sir, you said that the growth slowdown is probably over. Next half's growth will be better. But at the same time, you are saying that inflation pressure will be there, probably more than what we have witnessed. Are you indicating that February rate cut is also very risky?
I have not indicated anything about the future cycle of interest rates.
Thank you, sir. Next, I'll request Mr. Sachin Kumar from Financial Express.
Sir, the growth in unsecured loans, it has come down significantly in the past few months. So, but now there is one pocket of gold loan where the growth is very strong. So, do you think is it a cause of concern, and it may also warrant the same kind of measures to curb that growth?
I would request Deputy Governor Swaminathan to take that question.
See, the growth in unsecured loans at that point in time when we took some additional macroprudential measures last year was essentially to curb the exuberance that we saw in that particular segment, so that any possible stress or a risk build-up is avoided. So that was the intention with which we took that step. Otherwise, in terms of what should be the product mix as to how the banks should drive their business is purely a business call, and gold being a collateralized loan, the banks and NBFCs have shown a preference to grow. What is more important for us is to ensure that there is fairness in their conduct towards the customers, and then the appropriate norms relating to LTV, income to repayment obligations, etc. are being adhered to in a fair and transparent manner. So our instructions are more aimed towards ensuring orderly conduct of this business. Growth or product mix is something which is essentially left to the bank's wisdom to pursue.
Qualify as an exuberance according to you?
there are no golden numbers to determine as to which is less or which is more, and also you'll have to see the percentages in reference to the base. When we talk about almost 175 lakh crore of bank credit, what is the proportion that the gold loan of a lakh plus crore constitutes? So percentages at times can look different, but what is more important is whether the portfolio is being built in a responsible manner, in a prudent manner. So that is what we would keep watching. But in any case, we remain watchful of the incoming data, and if some prudence demands that we should initiate some action, we will take it at the appropriate time. At this point in time, the guidance in terms of the conduct would suffice is our view.
Thank you, sir. Next, may I request Mr. Piyush from Hindu Business Line?
Good afternoon, Governor, DGs. Thanks, Puneet, sir. Governor, sir, first question is with regard to Sachin sir asked about gold loans. My question is on MFI. A lot of MFI companies are seeing higher delinquencies, creating higher provisions. Is the RBI concerned about SHGs? Somebody mentioned only 6 months also they don't have any experience, but they still get loans. So in MFI sector, are we seeing any incipient stress building, and what are your views on that? And so separately, what gives you the confidence that current fiscal 6.8% GDP growth can be achieved, the revised projection that you have done? Because November, we saw 6%, 7% fall in UPI transaction. I know it's not a only indicator, but month on month, it's fallen 7%, and it is a month of festivals. So these are the two.
No, you see, on the gross number, I think I have explained it elaborately in the statement, and now also I have explained. Now, what gives us the confidence or no confidence? I think it's for you to assess whether our numbers for the third quarter are realistic. We have made our assessment, and we look at multiple factors. It's not just UPI is just one of the factors. But on the other part of your question on MFIs, I would request Deputy Governor Swaminathan to reply to that question.
Yeah, these are some of the segments in which, as we spoke last during the course of MPC as well, there are certain segments we saw increased slippages in the Q2 numbers that were emerging. And as we mentioned earlier, it was not very surprising to us because these were the segments which saw an outlier growth a year before, and we had taken some proactive measures on that. And we had also, if you recall, in the August monetary policy statement, Governor has said that in these segments where enhanced slippage is being witnessed, A, we have requested the banks and NBFC to strengthen their underwriting standards, and B, to step up on their collection efforts to ensure that the stress does not translate into NPAs. So on the same theme, we continue to engage with the entities wherever we see any outlier behavior. At the system level, it is still not a big concern. About 20-30 bips uptick in stress is something which we are confident that the entities will be able to handle. And in certain entities where these particular numbers are a little outlier, we deal with them on a bilateral basis, examining as to the steps that they are taking up to ensure that the stress is not widespread. And the third, of course, through the SRO, there are enough levers that are available to us to ensure that the self-regulatory organization in this particular space, in the MFI space, are taking adequate steps to sensitize their members to adhere to the prudential guidelines of Reserve Bank and ensure that the household income assessment and the repayment obligation towards the net monthly income, etc., are strictly adhered to. And as Governor said earlier, to avoid the push effect, just respond to the demand rather than give loans to achieve someone's target. So I think these are 3-4 key messages that we have managed to deliver in the last 2-3 months. I think that should be good enough to ensure that the balance is restored in this particular segment.
All right, so that is the Reserve Bank of India top brass, talking about the lack of a rate cut and the reason for the CRR cut in today's policy. Largely, no new big additional takeaways other than the fact that the RBI expects liquidity to significantly tighten at least up until February and later. And that is because of various reasons. The tax outflows that will start to happen from December onwards. Also the possibility of increase in currency in circulation as credit growth picks up, as well as the fact that we've been seeing some capital outflows from FPIs. All of that is going to lead to a tighter liquidity in the coming months, because of which the Reserve Bank of India today has taken the call to cut the cash reserve ratio by 50 basis points, even if today or maybe by Monday, there's no major tightness in liquidity for the system for now. But this is a forward-looking action. And again, the Reserve Bank of India governor highlighting the need for vigilance on inflation and the flexibility that a neutral stance gives the Reserve Bank of India to take action when data warrants this. And again repeating that the timing and the practicality of the decision is very important, keeping in mind that, the decision must only be taken, a rate cut or not, when it is going to be the most effective. With that, let me toss it to our experts to further decode the policy for us. Neeraj Gambhir, Group Executive and Head of Treasury and Markets and Wholesale Banking Products at Axis Bank, is with us, as is Soumyakanti Ghosh, the Group Chief Economic Advisor at State Bank of India, Pranjal Bhandari, Chief India Economist at HSBC, and Rikin Shah, Vice President of IIFL Securities, all with us. Pranjal, gentlemen, thank you very much for your time here. Pranjal, quickly, any additional takeaways from this press conference? Is your base case also a potential rate cut in February, given the current forecast of 4% only by the second quarter of next year in inflation?
Yes, thank you very much. Good to be here. So, look, I think a great balance was sought today. The RBI gave that rate cut, the CRR cut because of growth concerns, but did not give you the repo rate cut because inflation is still very high and it's prudent. You have to, take timely steps. Our sense is, yes, that in February we will see a repo rate cut. We do agree with RBI that growth will rise by then, inflation will fall, but we don't think the quantum will be as encouraging as RBI is thinking. We think we will see some rebound in growth, but not very much. For example, RBI is thinking in second half of the year, growth will average 7%. We think it will be closer to 6.5%. Tax revenue growth has slowed. We don't think the government can spend very much at this point. Winter has come in a bit late, so some of the agriculture produce may also not come on time. So we may not see rural demand also pick up very quickly. So we don't think growth will be that strong, and there will be pressure on RBI to act. In terms of inflation, again, we do think it will come down, but it may not come down as quickly as RBI is expecting it to. So given all of this, our sense is that yes, there will be repo rate cuts, and we are expecting one in February and April, but we think it will be a shallow rate cutting cycle of about 50 basis points. That's it. If anything more is needed, it's going to happen via liquidity. Today was the start, and I think over the next year, we'll see all kinds of liquidity instruments being deployed, from OMO purchases to longer tenor FX swaps and so on and so forth. So, just to cut a long story short, agree with RBI on many things, but we do think that growth will remain a problem for longer, and monetary policy will have to remain more accommodative for longer, maybe not by too many repo rate cuts, but a lot more liquidity.
So that growth inflation unsettled balance probably will remain so for a while. Pranjal, thanks very much for that opening remark. Mr. Soumyakanti Ghosh, on the growth numbers itself, RBI has brought down 7.2% for the year to 6.6%. But are you aligned with the kind of numbers they've given for the second half of the year? 6.8% for the third quarter and 7.2% for the fourth quarter. Mr. Soumyakanti Ghosh.
Yeah, thank you, Ritu. I think regarding the growth numbers, I'll just want to put some estimates back on the table, because if you look at the RBI monetary policy statements of the last couple of years, there is always a growth revision in October compared to August, because then the RBI has a fair amount of idea of what the growth is going to look about. But it was the first time in several years that the growth forecast was actually upgraded to 7.2%. If you look into FY 23 and 22, there was a 100 to 80 basis point downward revision in the RBI growth forecast, which later on actually turned out to be correct. So, and this time the RBI actually upgraded in October. Now we have downgraded to 6.6%. My sense is that yes, there will be a recovery in growth, but the growth numbers is not going to be as strong as the central bank is expecting. I think a number which could be closer to the 6 to 6.3% handle could likely turn out to be the final number, because as of now, yes, the RBI also has said it clearly in the press conference that urban demand is actually not holding up, even though rural is holding out. And our sense is that given the fact that liquidity is going to be a long-standing issue, so the CRR cut is welcome for the banking system. But in terms of the growth numbers, we are not as much hopeful about a 6.6% growth rate this year. So growth is likely to surprise on the downside. And on the inflation numbers also, I think it will take little while to come down from the levels because it has been continued to be sticky for the last several months and years, and it is unlikely to come back in a jiffy. So overall, it's a good policy, but I think on the expectations from the numbers are unlikely to be like that as part of the forecast.
Okay, Neeraj Gambhir, what's your sense? The numbers, do they look credible? Are you expecting a risk upside or downside on both CPI and GDP? And with the CRR cut of 4%, what next? What is your base case?
So, first of all, I think I found the opening remarks of the governor quite interesting and useful to think about. He's kind of, even though we have an explicit inflation target in the law, he's kind of brought some kind of balance back into our, RBI's own thinking in terms of the relative importance of growth versus inflation. Secondly, as most of your other commentators have said, that growth projections of RBI seem to be a bit optimistic, and we don't expect that to be realized. So that, in my mind, kind of sets the bar a bit lower in terms of a future interest rate cut if the growth projections were not to materialize. So I think, yes, the possibility of a February rate cut remains alive. Key data point will be growth. Even if there is a bit of upside surprise to inflation compared to RBI's forecast, I think the focus towards growth is something that we will see in future RBI actions. I do agree that liquidity remains the biggest issue for the markets, even though this time we've seen a CRR cut, and this should inject a fairly good amount of liquidity in the system, given the pressure on the currency and given the fact that the government spending is something which is kind of quite back-ended. I think there is going to be a need for providing continuous liquidity into the system and making sure that the overnight rates, etc., are well anchored. My final point is that while we have seen a CRR action at this point in time, there is a wedge in the market in the sense that the short-term money market rates are actually quite elevated despite the fact that the next possible action from Reserve Bank is likely to be a rate cut. That kind of creates an issue where the bank's funding cost is quite high. So I'm hoping that this CRR cut will actually help us bring the spread between overnight rate and, say, for example, CD rates and bulk rates somewhat lower. And that should help, in some senses, the system. But if that, were not to materialize, more liquidity actions will be required.
But Mr. Neeraj Gambhir, you expect that on the liability side, deposit rates have peaked. Some of the pressure will come off with this 1.16 lakh crores coming into the system?
So we are in a situation right now where the CD rates and the bulk deposit rates have actually sustained at a far higher level as compared to retail deposit rates. The retail deposit rates have been in this range for quite a while now, but we are seeing, periodic pressure on the bulk deposit rates, coming and going, particularly towards the quarter ends. I'm hoping that with this action, some of that will be sort of alleviated. We ideally, as a first step, we should see a better convergence between bulk deposit rates and the retail deposit rates. I do not expect banks to be raising their retail deposit rates at this stage when the next step from Reserve Bank is likely to be a rate cut, and the central bank is quite committed to providing liquidity into the system.
Okay. Rikin, again, what is the base case that you're working with? And going ahead incrementally, what do you expect to see on the liquidity front after this 50 basis point CRR cut that has been delivered?
Sure. Good afternoon, Ritu. So we were expecting a 50 basis point of CRR cut in this announcement. Repo rate, as most of the commentators have commented, and our house view has been that it could earliest be in Feb or maybe in April. In terms of the impact for the banking sector per se, the typical sensitivity suggests a margin uptick of 4 to 5 basis points for most of the banks and ROA uptick of 1 to 2 basis points. But that implicitly assumes that the funds which have been freed up due to the CRR cut will be deployed to the loans, which may not happen for all the banks. Given the LDR and LCR constraints which many banks are grappling with, we believe that it's mainly the PSU banks and select private banks who can see this entire flow through into the NIM impact. The second order impact of the CRR for most of the banking sector would be in terms of some easing in the deposit rates. If I look at the peak retail time deposit rates offered by banks in 1 to 3 year bucket from September onwards to now, they have kind of softened by 10 to 15 bits for select PSU banks, and the bulk deposit rates, they have also come off by 5-10 bits, but they still remain very elevated, as Neeraj also pointed out. So net-net, CRR cut is a welcome move for the banks, and the pushing out of repo rate cut also should support their margins in the fourth quarter fiscal FY25.
Okay, Soumyakanti Ghosh, some of the other non-policy measures, including the collateral-free agriculture loans, the limit being enhanced by about 20,000 rupees per borrower, are these incremental measures going to move the needle? When we talk about credit growth pickup in the system with the additional liquidity inflow from the CRR cut?
No, I think, Ritu, I think that agricultural credit from 1.6 to 2 lakhs is a very welcome measure. In fact, if you look into the data which is there in public domain, more than 95% of the records, land records are now digitized across states. I think this number was at 95%. It has not moved significantly higher. So the banks have been actually asking for an increase in this collateral-free limit, because now that the land records are digitized, so it will be easy and an operationally easy part on the banks to extend high-value loans to the small and marginal farmers. So the banks have been actually asking for this limit to be raised to 3 lakhs. Possibly the RBI may do it in a graded fashion, but I think it's a welcome move in terms of credit growth to the small and the marginal farmers. But on the larger question of liquidity, I just want to add one point. I think the villain in the room is the government cash balances, which has been fluctuating from this end to that end over the last 2 to 3 months. And the main issue is that the government has migrating the entire payment system to the just-in-time. So this means that an additional 7.5 trillion of overall government program will move into this JIT over the span of next 3 to 4 years. So if this is going to happen, so this will be the biggest elephant in the room. And you know that this is mostly this government cash balances is frictional in nature. So all these balances have actually moved outside the banking system to the e-cubed. And that is creating this imbalance. So from that point of view, this permanent liquidity injection on the part of the CRR is going to be welcome. But maybe on the liquidity, some more has to be done as we progress in the next year or so.
And what more could that be? Are you expecting, apart from VRR, perhaps some OMO purchases? What more are you expecting from the RBI in terms of the tools that they could use?
I think right now the argument was that temporary liquidity withdrawals could only be made by temporary liquidity injection. But as we have seen today, CRR is actually a permanent liquidity injection. So that's basically an acknowledgement that liquidity is going to be tight over the next couple of months. I think apart from that, one of the steps which the Reserve Bank has done today is cutting CRR headline. I think on product-specific CRR could also be cut of some of the deposits, which could also add a significant enabler to the banking system. And OMO could be another potent tool at a later point of time. There is enough pressure on the exchange rate once the new US president takes over. So there has to be on the table several liquidity enhancing measures. CRR could be one of them at this point of time.
Okay, Pranjul, you said you're expecting a shallow rate cut cycle of about 50 basis points. What are some of the risks you see to this? And you're, in terms of the next steps, you're expecting a change in stance to accommodative and a cut by February. That is your case?
Well, not a change in stance. I think there's really no need to change from neutral at a time. Then there are going to be so many global uncertainties. And neutral basically includes everything. You can be hawkish, you can be dovish, depending the flavor of the day. So I don't think the neutral stance will be changed. But within this neutral stance, I do think that we have space for 2 rate cuts. At this point, I'm hoping for February and then April. But there are risks, that they don't happen in that timeline, that they get delayed. And I think a lot will depend on the US dollar. If we start a world in 2025 where the dollar is extremely strong, maybe, in January, early Feb, dollar has strengthened even more, then my sense is we may actually wait and watch and not give that rate cut. Nothing can be set for certain in such a sort of a globally uncertain world. But if dollar behaves itself, if it's broadly stable, then I would go ahead and say that, the first rate cut, repo rate cut will happen in February. The other thing that I feel, we shouldn't take for granted is disinflation. food prices, we all are hoping falls, and we all are hoping that we see the winter disinflation. But there have been a couple of problems this year. One, the winter onset has been a bit delayed, because of which sowing has been a little bit delayed. And two, there has been some shortages of certain fertilizers impacting wheat and potato. So my sense is that if weather doesn't hold up in the next couple of weeks, then we can't take the disinflation for granted as well, despite having strong reservoir levels at this point of time. So there are many questions out there, but yes, my base case right now is that the first rate cut is going to happen in February and then the next one in April. Beyond that, it's going to be liquidity, as everybody else has also been pointing out, that will really do the work of supporting GDP growth.
Okay, Mr. Neeraj Gambhir, what is your base case? What will be the total quantum of rate cuts in the cycle? And what are the key risks to this growth and inflation dynamic?
So I think as far as the base case for February is concerned, I would say that February is live. I wouldn't want to put a probability on it as yet, because we need to see both the growth and inflation data play out over the next several weeks to see what happens. Pranjal has very rightly pointed out the global aspect of it in terms of dollar strength and the pressure on EM currencies. So I would say, yes, February is live, but very hard to take a call on what the probabilities are. I do feel that there is not a big case for making large rate cuts at this point in time. So I would feel that Reserve Bank will actually wait and watch out to see the data before taking each rate cut call. So it's a call in itself. So I don't think that if February is done, then April is automatic. It's pretty much that you take one step and then you wait for things to play out over a period of time. One thing that I wanted to call out was that we have seen a kind of wedge between the growth of deposit rates and the lending rates, the lending growth kind of narrow down. The advances growth and deposit growth is now pretty much close to each other, but that has happened largely because the banks have curtailed their lending. So effectively, while the deposit growth has not picked up, the lending growth has actually tapered down. One of the reasons why deposit growth has not picked up is because liquidity in the system was tight and there wasn't as much primary liquidity creation in the system. I'm hoping that with this CRR cut, we'll once again start the process of primary liquidity creation in the system. And if that process is sustained, we should see some benefit to the overall deposit growth in the system. And that's one thing which is, absolutely important for us to make sure that growth holds up. The reason for growth slowdown is also the fact that the credit impulse in the economy has turned negative over the last several months.
Okay, Rikin, what is your expectation in terms of the impact on banks? Largely our panelists have been telling us about 2 to 5 basis point improvement in margins. What about the NII front for some of the large banks in the system?
So yes, I would agree that the NIM impact should be 3 to 5 basis point and the PAT impact should be around 1%. But as I earlier pointed out, that may not necessarily flow through for all the banks. The banks who have lower LDR and higher LCR will be able to deploy this freed liquidity to loans. Others will put to some other uses. So that's the financial impact of the CRR cut. And one more additional point which I wanted to call out was the governor increasing the ceiling rate on FCNRB deposits. Yes. And what we have seen is that while the SOFR rate is around 4.6% and the existing spreads were 250 basis points on top of this, most of the banks were already offering rates much below the current ceiling in the range of 4.8 to 6%. So the further increase in the ceiling may not necessarily result in higher mobilization of FCNRB deposits. Perhaps any CRR exemption for these deposits could have spurred some growth in that, but otherwise they should largely be a non-event kind of a thing for FCNRB deposits for the banks.
Okay, that's an interesting view. Mr. Soumyakanti Ghosh, you think this FCNR deposit, ceiling being raised to ARR plus 400 to 500 basis points, depending on the maturity, this will not make the deposits that much more attractive? Will it not really move the needle?
I think so. I think this was exactly the same thing which we have been propounding in the policy, run-up to the policy, that there should be a CRR cut on specific liability products. And NRE deposits, NRO deposits, FCNRB was one of them. I don't think that giving this leeway on terms of the interest rate is going to help them, because that is, as my co-panelist said, that is being unutilized. And perhaps I think taking a cue And this has been done in the past also in the 1990s to give an encouragement to capital flows. I think a CRR cut on this product would have been more useful. So that's why I have been saying that maybe in terms of an headline CRR impact, there could be more micro-specific CRR impact on liabilities and products. And that could actually have a more meaningful impact on the liquidity in the system. So I think, so this is a good signaling, but I don't think it is going to help in any way in terms of the capital inflows.
And just to remind our viewers, the relaxation is only until March. So this is a 3.5-month window during which banks can offer these higher rates. Gentlemen, do thank you very much for being with us, all of you. Mr. Soumya Kanti Ghosh, Pranjul, Rikin, Mr. Neeraj Gambhir, thank you for sharing those thoughts. Pranjul, before we let everyone go, any closing comments on any other highlights? Do you think any reading between the lines that you want to highlight for us from the press conference or from the governor's statement that we haven't discussed so far?
Well, I think the one thing that sort of keeps coming up, every meeting is the way RBI is focused on inflation targeting. Despite commentaries from government or from like market participants, I think it's really focused on seeing this whole food disinflation and coming closer to 4%, maybe not exactly at 4%, but definitely, lower than 5%. And I think that today what it showed was even if sort of growth disappoints, they're not going to take any knee-jerk reactions. And I think this sort of firm belief that they're an inflation targeter and that's their primary objective and everything else is slightly secondary, I think sort of stood out quite a bit for me today.
All right. On that note, Pranjul, gentlemen, thank you very much for your time and for helping us parse through this policy. And we will continue that discussion, with other guests that are joining us. Mr. Ubesh Revankar from Shriram Finance is also joining us now. Mr. Revankar, thank you very much for your time here on CNBC-TV18. No repo rate cut, but a 50 basis point cash reserve ratio cut like the markets was, expecting. Start by telling us what is the impact on, lenders like Shriram Finance.
Yeah, basically, I felt that the status quo would be continued because of the inflationary numbers which have been there for last couple of months. And yes, the CRR cut is a welcome step because some liquidity will be there in the system. I think the government spend will start now, and with the CRR cut, there will be more money will be available for the infrastructure development, and that is going to give a lot of opportunity for other businesses, because when government spends, there are so many other businesses get an opportunity, like contractors, subcontractors, and new employment. All those things happen. And I believe that this is the right time, little more liquidity comes into the system and helps the growth, because we definitely feel that there is a growth opportunity coming up in the this quarter and next quarter.
Okay, Mr. Revankar, we had some of the other panelists earlier talking to us about the FCNR deposit, a ceiling being raised by about 200 to 300 basis points over what banks were already offering. This is for a limited period, of course, until March of next year. Is this going to make this deposit segment marginally more attractive? Do you think it'll move the needle?
I cannot really comment on the bank deposit growth, but I feel bank deposit growth is already in positive, in the sense there has been improvement in bank deposit, especially in the last couple of months, and making a little more attractive for various deposit definitely is a good sign. Plus, because the government banks do need additional resources for lending the growth. So I think that is definitely a positive one.
And what about your cost of funds, Mr. Revankar? How do you expect that to pan out? Repo rate for now staying put at 6.5%. Some liquidity, of course, coming in for the banking system.
I think banks will definitely now push for growth. There has been some slowdown in bank credit, and bank will find new avenues for lending. And also, being the one of the intermediary part of the financial system, the NBFC industry also will feel that will be more resources coming to the NBFC for the last mile reach.
Mr. Revankar, a larger comment on the lending rates as well. With repo being left where it is, just tell us what are the sectors where you're seeing some pickup as well in credit, sort of demand, with the kind of GDP forecast that the RBI is given at 6.6%. Where are you seeing pickup?
The basic, my sense is that the pickup will come from the government spend basically, and whether it will come back into real estate in a big way is question mark, because the real estate to really grow, what is needed is indicator of rate going down, because the borrower, the housing borrowers prefer to borrow at lower rate. That indication is not really there. So basically, I feel the infrastructure-led spend is more important right now, and those industries which is linked to the construction infrastructure will see growth.
So you're seeing, you're expecting a credit growth in these segments despite the lower GDP forecast that we have now from the RBI.
The lower GDP numbers, see, basically what happens is the rains slow down in August, and September is the full month for the mining infrastructure activity. This time around, the rains were there till the September end. So last quarter number may not be the reflective of the economic growth or but the RBI has brought down the numbers to 6.6. That may be a long-term trend. So 6.6 GDP growth is a good enough growth for the economy to grow and for credit demand.
All right, Mr. Revankar, before we let you go, quick word on what happens to your lending rates going ahead from here.
We were really not really expecting a change in the lending rate. So the lending rate will remain at present level, and our net interest margins also will remain at present level. So at least for a couple of quarters, till there is a significant change in the environment and maybe the RBI's outlook. And unless the repo rate comes down, I don't really see. The CRR cut will only help higher liquidity in the system, but it doesn't really help in reducing the rates.
Yes, Mr. Revankar, thank you very much. So until there is a cut from the RBI, you're hopeful of protecting your margins and, of course, your lending rates. You do not see any material changes. Thank you very much for joining us on that with your take. With that, we're going to wrap up this special discussion of the RBI monetary policy. We have to take a short break, but on the other side, we'll continue our coverage on other news and updates, so stay tuned.
Now, even as liquidity in the banking system remains adequate, system liquidity may tighten in the coming months due to tax outflows, increase in currency in circulation, and volatility in capital flows. To ease the potential liquidity stress, it has now been decided to reduce the cash reserve ratio, that is, to reduce the CRR of all banks to 4% of net demand and time liabilities, that is NDTL. And this will be done in two equal tranches of 25 basis points each, with effect from the fortnight beginning December 14th and December 28th.
Revises its GDP growth outlook for FY25 to 6.6% from earlier 7.2% following the sharp dip in the second quarter, even as it remains hopeful of a correction in H2 on the back of revival in cement, steel and power sector. RBI raises the cap on collateral-free agricultural loans to Rs 2 lakh from Rs 1 lakh to account for the increase in prices on agri inputs. The move is aimed at easing bank credit access to needy farmers. Hello, good afternoon. You've tuned into CNBC-TV18. You're watching Business Lunch and I'm Vinny Motiwala. We're celebrating 25 years today, but what was important also was the RBI Monetary Policy meet that came in today, and we saw a CRR cut of 50 basis points. Let's look at what the market did on that front and what we're seeing in Nifty. flip-flopping between the red and the green is what the Nifty was doing through the day as well. Right now, let's see where it's holding on to. Some bit of that very muted line and performance that we're seeing. 24,700 is what the Nifty is holding on to. Quite flat in trade right now, that's what we're seeing. Nifty Bank, that's holding on to gains of 0.03%. And if you look at the chart also today, at one point of time, Nifty Bank was trading in the red. Then it saw a recovery coming in, and Nifty Bank, as of now, is just flip-flopping almost near the day's highest point. Keep an eye out on that one. 0.01% uptick is what we're seeing coming in for the Nifty Bank. 53,600 is what the Nifty Bank is holding on to. Nifty Mid and Small Cap, that's seeing a better performance than the benchmark indices today. So broader markets are holding on to decent gains. Nifty Small Cap holding on to gains of almost 1%, and Nifty Mid Cap holding on to gains of 0.5%. So that broader market outperformance seems like that's continuing. Sectors which are dragging and not doing well today, we have Nifty Auto, that is among actually the top sectoral gainers. PSU Banks is the top sectoral gainer, while the drag is coming in from the realty and IT side. So keep an eye out on these sectors as well and where they are headed. But Nifty overall as a market today, not much of a move that we're seeing. We've seen it recover from the day's lowest point. As of now, just holding on to those levels since the last half an hour. But let's talk about a stock that is specifically in focus today. We'll talk about Strides Pharma. Why are we talking about Strides Pharma today is because today is the record date of the spin-off of its OneSource business, which is the CDMO business of the company. So today we're seeing Strides Pharma. So the rate will automatically get corrected when you see tomorrow, because today it opened up, the rate when you look at it, the opening rate, because this is the spin-off business. So the stock is trading at 682x of that CDMO business side. So yesterday the stock was at 1,400 approximately, the price that we were looking at. 1,400 is the level that was there. So today it's because the X price is showing 54% decline, but it's not a decline. We're seeing a 5% uptick from the morning price for Strides Pharma X the CDMO business. And the CDMO business as the OneSource side will be expected to actually get listed in Jan and Feb. So keep an eye out on that one. OneSource overall the stake was worth around 638 rupees per share. So you have to exclude that part. And today when you look at it, the business would be valued around 850 rupees per share. This is according to the analyst that the highlight is coming in. In Q2 also the company had highlighted a lot of positive stuff in terms of the CDMO business. Let's not forget that Biosecure Act benefit that comes in from the CDMO side of the business. That will come into first OneSource as well. Second half of the year is expected to see a pickup coming in, so we're expecting better performance there. And the 3 to 4 year outlook that the company had given for this OneSource business was around 350 to 400 million in terms of revenue with a 40% EBITDA. So keep an eye out on Strides Pharma. Tomorrow, on Monday when we open up again, we'll see those adjusted rates coming in for Strides Pharma. But yes, that's on Strides. Keep an eye out on this one. As of now, when you look at the BSE and NSE rate, the adjusted rate, it's a 5% uptick that is going to be coming in on that front. But yes, on that note, I think we're going to take a very short break, and after the break we'll come back and talk about the latest action that is going to be happening in terms of the winter session of the Parliament. So stay tuned for that update.
After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook. The Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%.
From sharp insights in the political arena to all the excitement from the world of sports. are here at the CNBC-TV18 Budget Headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18. For 20 years, it has been India's most coveted stage for business leadership. The benchmark of unparalleled excellence.
We have to dream big and even bigger for India.
An accolade that celebrates character, integrity and decisive action.
You just have to do your best.
Not identified by any single name, nor defined by a single achievement.
The best years are to come and you don't have to wait for long, it's round the corner.
But redefined every year by visionaries who inspire and legends who lead. A journey that honors those who set the bar higher year after year. This is not just an award, it is a celebration of leadership in action. CNBC TV18's 20th India Business Leader Awards.
Presented by Standard Chartered in association with Reliance Industries Limited.
Inflation, on the other hand, surged above the upper tolerance band of 6% in October, driven by a sharp uptick in food inflation. Food inflation pressures are likely to linger in Q3 of the current financial year and start easing only from the Q4 of the current financial year, that is from January to March. And we expect that this is
Welcome back. You're watching Business Lunch on CNBC TV18 and thanks for staying tuned in. Today we're celebrating 25 years, but a stock that is buzzing in trade today, let's talk about that. We have Samvardhana Motherson that is buzzing in trade today. It saw a sharp jump up and then it saw a decline and again making a recovery, holding on to gains of 1.5% right now. Now, what is the reason? Why is it buzzing? Because there's some new acquisition that has come in and Sudarshan is here to tell us why is it buzzing? What does this new acquisition mean for the company? Sudarshan, good afternoon.
Afternoon, Vinny. So Samvardhana Motherson yesterday in the late night announced that it would hold board meeting today, and we were expecting of certain announcements. Now that announcement has come. Samvardhana Motherson is going to acquire a Japanese company named Etsumitake. Now it's an all-cash deal. The deal value is $57 million, that is around rupees 483 crore. And post the acquisition, the final shareholding, Motherson would hold 95% in Etsumitake and remaining 5% will be held by Honda Motors. Now, if you go through the deal steps, in the first step, Etsumitake has created a special purpose company which will take the holding to 48%. 48% is the threshold limit. Now, of that 48%, that special purpose company has already acquired 31.7%. Now it has to acquire remaining 16.25%. Then its holding will be 48%. And 48% holding is a must for the deal to go through. In the second step, Samvardhana Motherson will procure shares from that SPC, and that share acquisition is expected to be completed by this Q4 of FY25. Now, in the third step, Honda Motors will launch share buyback, and in the last step, acquisition of shares of other company. Etsumitake has certain subsidiaries, and shares of those subsidiaries will be acquired by Samvardhana Motherson. And finally, this Samvardhana Motherson will have 95%, Honda Motors 5%, and final deal is expected to be completed by Q1 of FY26. Now, what does Etsumitake do? It's a high machine production company, and it produces like gear shifters, chassis and transmission parts for four-wheelers and two-wheelers. In FY24, turnover of Atsumitec was $412 million, which was a jump of almost 12% year-on-year, and margin was 7.5%. That was up 340 bips year-on-year. So all in all, there was an expectation of a higher amount of acquisition, but nevertheless, acquisition has come and Samvardhana Motherson is going to acquire a Japanese company for $57 million.
Okay, Sudarshan, thank you so much for that update coming in on Samvardhana Motherson, keeping an eye out on that stock, holding on to gains of around 1.5%. But that's all the time we have on this edition of Business Lunch on CNBC TV18. Thank you so much for tuning in. Don't go anywhere. Your Mid-Cap Radar up next.
trend, and it will be backed by seasonal correction in vegetables prices, Kharif harvest arrivals, likely good Rabi output, and adequate cereal buffer stocks. The weaknesses in the manufacturing sector, however, was not broad-based, but was limited to specific sectors such as petroleum products, iron and steel, and cement. Going forward, high-frequency indicators available so far.
A lot to talk about on the show today, so let's start with all the top stories that we're tracking this afternoon for you. Stocks see a two-way swing on both mixed domestic and global cues. Even though the RBI's liquidity boost is seen as a welcome step, auto, metal and consumer durables eke out some gains, whereas IT, realty drag, mid-caps surge.
RBI defers a rate cut, keeping a prudent eye on global developments and the growth inflation dynamic, even as it marks up its inflation expectations for FY25 to 4.8% from 4.5% earlier. Economists, they are betting on a rate cut in Feb.
RBI cuts the cash reserve ratio for banks by 50 basis points, boosting liquidity in the banking system by about 1.16 lakh crore rupees. Bankers see deposit rates peaking out following this, but banks' margins will improve no more than 3 to 5 basis points.
RBI revises its GDP growth outlook for FY25 to 6.6% from 7.2% earlier, following the sharp dip in the second quarter, even as it remains hopeful of a correction in second half on the back of revival in cement, steel and power sectors.
The RBI raises the cap on collateral-free agri loans to about 2 lakh rupees from 1.6 lakh to account for the increase in the prices of agri inputs. This move is aimed at easing bank credit access to needy farmers.
Okay, those are the top headlines, and of course RBI is dominating the mindset today because we've seen some big decisions come by as well. But the rate cut question, that continues to remain. The GDP growth forecast has been cut. Inflation forecast has been increased by the RBI. And it turns out to be a very choppy session. We did see that sharp recovery around 10:30 a.m. But after that, it's been very volatile for the markets. Nifty is absolutely flat with some negative bias. Mid-caps are outperforming, though now as we speak, it's come up from the highs. The small cap outperformance continues. That index is up around 0.9% as we speak. And it's been outperforming the mid-caps also for most of the trading sessions in the last couple of days. PSU banking index doing well. CPSE continues to do well. And a lot of individual names, which we'll speak about in just a bit.
Absolutely. You're looking at the mid-caps doing extremely well. The last half an hour or so, the genre that the market was playing when it comes to music is metals, heavy metals. If you look at the Nifty Metals Index, it was absolutely flat for most of today's trading session. Just the last half hour or so, there's been a big move up around 1.5%, led by Vedanta, Tata Steel, all the metal stocks and metal-related stocks as well. Case in point, something like a Rain Industries, which is up around 8%. And the other theme that continues to work well for the market is the recent F&O entrants. So if you look at the list of F&O entrants, in that the recent F&O numbers, we have Delivery, which has moved higher at the high point of trade. The other one is HFCL. So both Delivery and HFCL up anywhere between 4 to 6%. But that's not all. We have a lot of other mid-cap movers, for which we have Hormas to take us through the mid-cap movers.
Might be choppy for the benchmark indices, but the mid-cap index and the small-cap index are in a league of their own, as has been the case for a better part of this week. So we'll start off with the gainers then in the broader markets. And as Mangalam just highlighted, it is most of these new F&O entrants that are doing well, right? So like the likes of ITI, HBL, Power Systems, MCX, Delivery, all of them seeing healthy gains of anywhere between 6 to even 16% now for ITI as we speak. All of them nearing or at the highest point of the day. Metals as a sector continues to do well. As Mangalam just mentioned, Vedanta is now also at the highest point of the day, 6.5% higher for Vedanta. Hindustan Copper, Hindustan Zinc, all of them seeing that sharp surge in the last half an hour of the trading session. Some of the other movers then within the broader markets, as the PSU space itself that is seeing a fourth day of gains now for the PSE index. IRFC, another new F&O entrant, 3.5% higher, and most of the other index constituents too seeing healthy gains in today's session. Stocks that are doing well on the back of volumes, and and PB Fintech is one of them as well. But Asahi India, CESC, Blue Star at one point was up 7%, still holding on to 5% gains in today's session. And lastly, some of the underperformers that will come up on your screen, those are the ones that are not doing well today. HEG continues to decline at 4% down today, and Canfin Home, Signature Global, some of the real estate names too, not having a good day today. Back to you guys.
Okay, all right. Thank you so much, Ormaz, for joining in with all those details. It's a good time then to get a technical check on the markets. Himeen Kapadia is joining in now. Himeen, good afternoon. Thank you so much for joining in. Well, what's the next level to watch out for on the Nifty, and any individual names that you are betting on today?
Very good afternoon, Sonal. Thank you for having me on the show. A very, very happy birthday to CNBC on its 25th birthday. As far as Nifty is on, it was 24,492, 24,800. Now we're there. So 25,200 and 25,700. These are the next two levels coming in. Maybe there could be a small cool off, but I believe these levels are there on the horizon. It might not happen in a jiffy, but things are obviously looking much better now. Individual stocks of Sonal, buy call on Escorts. One can buy Escorts at around 35.20, stop loss 34.50, target of 36.60. Oversold, positive divergences, crossover buys. Second one is once again in the auto stock, auto pack. You can buy Maruti at 11,300. It's formed a base. It's forming a rounding bottom. Indicators have given a crossover buy again. One can buy it at 11,300. Stop loss 11,150. Target 11,600. So.
All right. So those are a couple of stocks. But what do you make of a bunch of these mid caps? And what would your index trade be? You said that things are looking good. Do you think this, consolidation around the flat line is a place for one to go long? If yes, then it's the Nifty or the Nifty Bank that you're talking about?
The Nifty Bank is stronger because the gap didn't get covered up, Mangalam. The Nifty Bank did. The Nifty did, Nifty Bank did. Relative strength coming in. But having said that, I believe Nifty can play catch up. So 24,800 will provide resistance. We've been up very sharply. So I'd wait for a small cool off to answer your question. Somewhere around 23 to 20, around 24,500 is the level I would look to go long, Mangalam, with a target for 25,200 for the month of December.
Okay, all right. Thank you so much, Himeen, for joining in and taking us through your picks, and have a great weekend ahead. With that, we'll slip into a short break. On the other side, we get to excerpts of our conversation with Gunender Kapoor from Vishal Megamart.
Suggest that the slowdown in domestic economic activity bottomed out in the second quarter of this year, and it has since recovered, aided by strong festive demand and pickup in rural activities. Agricultural growth is supported by healthy kharif crop production, higher reservoir levels, and better rabi sowing. Industrial activity is expected to normalize and recover from the lows of the previous quarter. Now, even as liquidity in the
Welcome back. You're still tuned into Midcap Radar. This is our IPO KYC special. My colleague Reema Tendulkar spoke to Gunender Kapoor, who's the MD and CEO at Vishal Megamart, on their IPO, use of proceeds, and much more on the company. Listen in to a slice of that.
Firstly, the promoter stake is coming down from 98.77% to 76.02%. And I must say that they would continue to be the promoters and one of the large shareholders in the fullness of time too. They have a long-term commitment to the business. Now, as you know, we are largely private equity owned. So therefore, and private equity investors have been invested now for over 6 years. And therefore, this is just a dilution of this stake and an effort to make it a publicly listed company.
PE companies have a fund life.
Sure.
So there is always a risk of further supply coming through. So what is the commitment
from
correct. from the Kedara group?
That's absolutely correct, Reema. And therefore, we've been very upfront with all the potential investors that Samayat will continue to be a promoter of the company. And the private equity investors have a long-term commitment to the business. They're very excited about the future of this business, and therefore there should not be any significant concern on that front at all.
So let's just talk about the near term, because off late we've seen some sort of consumption fatigue coming through, slowdown. So are you confident, at least in the near term, the next 12 months, that the numbers that we've seen so far, a 19% revenue growth in H1 or a 13-14% kind of same-store sales growth will continue, say for the near term?
I'm seeing some pressure on consumption. We've seen that in the first half. And I would say that we've had to do more to get double-digit same-store sales growth. But we are confident about the future.
So, Gunender, we have your numbers for the last 3.5 years now.
Sure.
So margins are largely between 13 to 14% at the EBITDA level. Gross margins broadly around 28%. Has that been the long-term trajectory? And do you think over the longer term, minor fluctuations here and there, investors can expect this?
Without being specific, I would say yes. Okay. I would say that our general view on gross margins is that we would maintain them at the same ballpark. Okay. And we may get growth on our EBITDA and PAT because of the operating leverage that we will enjoy. As you've seen historically, we grow at double-digit same-store sales growth. And if the cost inflation is around 5, 6, 7%, then we do benefit from it.
1 billion internet users, but yet your online presence is negligible in terms of revenues and profits. Why is that? And is that something you're looking to scale?
So we are largely an offline retailer, as you rightly said. We have in the recent years started a pilot, in fact last year, which we are rolling out at the moment. To ensure that we are present in the quick commerce space in a relevant way. And this quick commerce platform is such that it operates within, let's say, 7 to 10 kilometers radius of each of our stores. And when you log into our app, you get automatically tagged to the closest Vishal store. And you can see the merchandise available in that store. And if you were to place an order, and if you would choose to, we could deliver to you within 2 hours. And if you were to buy more than 299 rupees, the delivery would be free. Okay. So we are quite encouraged by the early response. And we are now rolling out this quick commerce platform to other stores beyond the pilot. And as we speak, we are present now with our quick commerce platform in 375 odd cities in India. So yes, in a very relevant, capital efficient way, we will ensure that we bring to our customers the benefits of digital commerce.
So what are the revenues and profit numbers of your overall online presence and of quick commerce today?
It's still in a pilot stage, so I wouldn't quite go to the numbers. I would only say that it's shown.
But you're in 375 cities offering
it's
quick
just
commerce.
happening as we speak.
As we have.
Yeah.
Okay.
So it's.
And what's the investment you've put in?
It's not significant because you would realize that there's no dark store there. It's only from a retail stores. And the inventory is fungible between the store and the...
So there will be no cash burn, as we see with other quick commerce
companies? There would be some to begin with, but very small.
Very small.
Yeah.
Okay. Enough to dent your margins as it scales up?
No.
You will make sure?
Yeah, at this moment, as you can see, it's not dented our margins.
So now let's talk about your store count addition. On an average, you've been increasing your store count by 10%, at least based on the data that we have. Today, you're present in 645 stores. What's the expansion plan?
So you're absolutely right. That's the pace at which we've expanded. Our experience with new store rollout has been very good. For example, I'll share just one data point with you. Our payback on capex, store capex, is 19 months, which to the best of my knowledge is the shortest in Indian retail. So that is very encouraging. And we are hoping to scale up a new store rollout to something like 80 to 100 stores per year now. But I must underline the fact that the goal is not only to open new stores, but it's to open new successful stores. Rima, at the moment, we are present in 30 states and union territories in India. We are present in 403 cities. When the erstwhile Vishal Retail was first acquired in March 2011, through the bank-run CDR process, it was indeed largely a north and east company. And in the earlier years, of course, the objective was to expand into north and east because our coverage was somewhat patchy at that point in time. And then we have ranked all the states in India based on the cost structure. And obviously, we are going from low cost to high cost. And as we speak right now, we are opening stores in Kerala. And after that, there would be essentially 3 states in India that we would be looking at for expansion, which are Tamil Nadu, Maharashtra, and Gujarat.
And this cash on the books of 700 crore rupees, how do you typically utilize it? How much goes in adding, say, 80 to 100 stores every year?
So a significant part of our cash will go into growth. So as I mentioned, it will be at least 30-40% of our cash will go into that. Then we, as I mentioned, the e-commerce pilot and so on, we are looking at several new initiatives.
Banking system remains adequate. System liquidity may tighten in the coming months due to tax outflows, increase in currency.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The
markets are betting big on affordable housing. You look at the kind of stocks that have risen. We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook. The Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen. We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18. For 20 years, it has been India's most coveted stage for business leadership. The benchmark of unparalleled excellence.
We have to dream big and even bigger for India.
An accolade.
Welcome back. Frontline indices meandering just beneath the flat line. The mid-cap index is where all the action is, and in that as well, while the conversation with the management of Vishal Mega Mart was going on, we did see a couple of stocks in the retail space spike itself. Maybe a bit of a valuation arbitrage playing out there. We have Bazaar Style Retail, a recent IPO. That stock is up around 9%. The other one that is spiking also is Spencer's Retail. So just keep an eye out on these couple of stocks. And beyond that, we do have Tilak Nagar Industries, which continues to surge as well. So as soon as the price band of the Vishal Mega Mart IPO did come by, we did see an up move on these retail stocks, and Tilak Nagar Industries goes into Friday with a big cheers for all the shareholders. With that, we end this edition of Midcap Radar. Your stocks when we return.
Celebrates character, integrity, and decisive action.
You just have to do your best.
Not identified by any single name, nor defined by a single achievement.
The best years are to come, and you don't have to wait for long, it's round the corner.
But redefined every year by visionaries who inspire and legends who lead. A journey that honors those who set the bar higher year after year. This is not just an award, it is a celebration of leadership in action. CNBC TV18's 20th India Business Leader Awards.
Presented by Standard Chartered in association with Reliance Industries Limited.
After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook. The Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18. For 20 years, it has been India's most coveted stage for business leadership. The benchmark of unparalleled excellence.
We have to dream big and even bigger for India.
An accolade that celebrates character, integrity, and decisive action.
You just have to do your best.
Not identified by any single name, nor defined by a single achievement.
The best years are to come, and you don't have to wait for long, it's round the corner.
But redefined every year by visionaries who inspire and legends who lead. A journey that honors those who set the bar higher year after year. This is not just an award, it is a celebration of leadership in action. CNBC TV18's 20th
Green, 24,670-680 levels is what it's holding on to. Keeping an eye on that, as of now, again, the market has gone into the red. So let's see in the next 1 hour of trade, where are we going to be headed? That's going to be important to watch out for 1.5 hours. But 24,676 is what the Nifty is at. Nifty Bank, that also, we saw that spike up coming in when the CRR cut came in for the Nifty Bank, but then again it started flatlining, just flip-flopping between the red and the green is the Nifty Bank also as of now. So off the day's highest point is what the Nifty Bank is trading at. Mid and small cap, that's managing to hold on to gains. That is not going anywhere. The mid and small cap run up that we're seeing. Small cap also holding on to gains of 0.8% in trade. So yes, that's how the market setup is looking like. But this is a show where we'll be solving all your stock related queries, and we have our experts joining in with us. We do have Shaina Mukaddam, independent market expert, as well as Vaishali Parekh, head of technical research at Prabhudas Leeladhar, joining in with us. Very good afternoon, ladies. Thank you so much for joining in with us. It's a very special day also because it's our 25th anniversary that we're celebrating. So, Vaishali, let me start with you. Today we had the MPC meet. We saw Nifty Bank see a bit of a spike up coming in. But now we're seeing a bit of a fall again, right? It's almost a flat line. What is the Nifty Bank looking like in terms of a move that we could be seeing?
Good afternoon, first of all, to all of you, and heartiest congratulations on this important day. Yes, so Bank Nifty, we saw yesterday it did surge high, and it's very well maintaining above the previous high. So the bias still continues to be positive as far as Bank Nifty is concerned, though it's just a sideways move post the RBI announcement. But I would say that at the current scenario where we are seeing Bank Nifty, we would have a range of 53,000 levels as support, and the higher projected target comes to around 54,500 to 56,000. And having said that, even with Nifty, yesterday, well, we did see the crucial resistance levels of 24,800 being met with. So now if we see this Nifty moving above that, then I think we would be looking at 25,200. So that's how we are looking at the market currently.
Okay, that's how we are looking at the market currently. But on that note, let's get started with all the stock-related queries that we have. And the first query that we have today is on Adani Green. This one is coming in from Lakshmi Rao, who's writing to us from Telangana. She's holding 25 shares of Adani Green at a price of 2,315 rupees per share. So currently, obviously, they're making a loss on this one. Wants to know whether she should continue to hold or maybe just book out her losses. Shaina, good afternoon. Take the query first for us.
Now, before I go to answering that, best wishes, 25 years. I have been, part of this long journey along with you for most of it. And I look forward to the next 25 years and more. So my best wishes to you, CNBC, the whole team. I think you're doing a wonderful job and look forward to keep watching you and participating with you guys over the next couple of years. Yeah. So now coming. Yeah, thank you. Coming back to Adani Green, see, basically valuations are extremely expensive. Now, so any negative news, the stock will continue to take a hit. And the limited upside that we see because of the expensive valuations is likely to see the stock remain in this range, one way or the other until some news break, positive or negative, takes place. Secondly, I think, the fundraising capacity of the company is likely to be questioned, or they may have issues, because we also have Total Energies, which is an investor in the company, holds equity in not only Adani Green but in other group companies also. They have said they are going to limit their investments, at least for now. So all these things put together, I would say it is better to switch.
Okay, better to switch. That's the word coming in from China on Adani Green. But on the technicals, Vaishali, what is Adani Green looking like?
No, so I would not really be in favor of this right now because it is showing weakness. There is no clarity. So I would say that rather get into some other stocks which show better strength.
Okay, look at some other stocks that are showing better strengths. That's the word coming in from both our experts. Let's move on to the next query. Again, this is coming in from the Adani Group side that we have. It's on Adani Ports. Now, Mahesh is writing to us from Tamil Nadu. They're holding 100 shares of Adani Ports at a price of 1,360 rupees per share. Currently, stock is trading at 1,262 rupees per share. So, what should they be doing with this one? Whether they should continue to hold this, book out losses, look to average? Shaina, what are the fundamentals looking like for Adani Ports?
Well, here again, the fundamentals remain strong. Of course, it is the largest player in the port segment. The ports industry itself in the next 25 years is expected to go up by 4 times. And Adani management has actually said that in the next 5 years, they are looking to double their volumes, revenues. So I think to that extent, we are likely to see good performance going forward. They already are reporting very good performance if we see the last couple of quarters. Having said that, again, I think the major problem over here is that it is not cheap, but and any negative news that comes about for the group, like, the stock may take a hit, it may consolidate for some time till there's a resolution on the US issues that have risen in the recent past. So having said that, I'm very interested in the port segment as a whole to be an investor. Look at the other company, JSW. I would say that it's a switch. You could look at JSW Infra, which is very tiny compared to Adani Ports, but at the same time, valuations are more or less similar. So if you want to be safe, if you want to play safe, then better and be in the sector, then you can switch. Otherwise, you can hold with a stop loss, and it is a risky investment.
Okay, that's a word on Adani Ports. Keep an eye on that one. But on the technicals, what is it looking like, Vaishali? Should the viewer continue to hold this or maybe just book out profits?
So, well, I would look at there could be another probability that, yes, see, overall, the long-term trend has been very intact. When I'm looking at the weekly chart also, 1,000, which we saw in the recent past, was a very prominent support. So, of course, this stock is quite prone to a lot of vulnerability. But I would say that, well, if you don't mind taking the risk, keep accumulating with 1,000 as the support level, because we have also seen tremendous returns coming from these stocks. So if 1,000 is the stop loss that he is ready to maintain and buy at lower levels to average his cost, I think it's worth a wait to look for higher targets going towards 1,500, 1,600.
Okay, keep an eye out on those levels over there for Adani Ports. Let's move on to the next query, and this one is coming in from the hotel side. We have on Indian hotels. So the viewer is Jaishil Ketani, who's who's writing to us from Mumbai, holding 115 shares of Indian hotels at a price of 128 rupees per share. Wants to know the future prospects of his investment in Indian hotels. And in the last 6 months, when you're looking at the stock move also, it's seen a good up move, 42% uptick. Vaishali, Indian hotels on the technicals, what is it looking like?
So on the technicals, overall, all hotel industry stocks are doing very well. And of course, Indian Hotel being the front runner, we have seen tremendous good run coming in. But stock is also getting into the overbought zone. So whether I'm talking about the daily chart or the weekly chart, so I would say no harm booking partial profit or continue holding with the trailing stop loss.
Okay, continue holding with the trailing stop loss is what you're seeing. But on the fundamentals, Shaina, hotel space, there is so much that is happening here. I don't think hotels are ever going to go out of style, right? And I don't know whether the stock will or no, because you have those concerts, they can charge any prices that time. You have the holiday season that is there. So fundamentally, what is Indian hotels looking like?
I totally agree. Actually, while the stock is expensive, it has always been expensive in the last couple of years. I would say that going forward, not only asset backed, they're also looking to increase the revenues with management fees, adding fees based on taking over hotels for management. So to that extent, I think, it's a good growth story. You can hold it in your core portfolio and keep it for the long term.
Okay, hold it in the core portfolio, can keep it for the long term. That's the word coming in from China on Indian hotels. Keep an eye out on that one. But on that note, we're going to slip into a very short break. Don't go anywhere, because after the break, we'll still be taking all your stock-related queries.
Business Leader Awards.
Presented by Standard Chartered in association with Reliance Industries Limited.
Inflation, on the other hand, surged above the upper tolerance band of 6% in October, driven by a sharp uptick in food inflation. Food inflation pressures are likely to linger in Q3 of the current financial year and start easing only from the Q4 of the current financial year, that is from January to March. And we expect that this is the trend and it will be backed by seasonal correction in vegetables prices, Kharif harvest arrivals, likely good Rabi output and adequate cereal buffer stocks. The weaknesses in the manufacturing sector, however, was not broad-based, but was limited to specific sectors such as petroleum products, iron and steel, and cement. Going forward, high-frequency indicators available so far suggest that the slowdown in domestic economic activity bottomed out in the second quarter of this year, and it has since recovered, aided by strong festive demand and pickup in rural activities. Agricultural growth is supported by healthy Kharif crop production, higher reservoir levels, and better Rabi sowing. Industrial activity is expected to normalize and recover from the lows of the previous quarter. Now, even as liquidity in the banking system remains adequate, system liquidity may tighten in the coming months due to tax outflows, increase in currency in circulation, and volatility in capital flows. To ease the potential liquidity stress, it has now been decided to reduce the cash reserve ratio, that is, to reduce the CRR of all banks to 4%. Of net demand and time liabilities, that is NDTL, and this will be done in two equal tranches of 25 basis points each, with effect from the fortnight beginning December 14th and December 28th.
CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency.
Earlier have now become more reasonable. If you look at current year, it's about 5 times price to book, which is not too expensive for an NBFC like Bajaj Finance. 1 year forward, it will be 3.5 times price to book. So to that extent, yes, it is starting to look attractive. Having said that, I think in the near term, it is likely to continue to consolidate around current levels. They actually recently have discontinued their co-branding of card business. That should affect a bit in terms of business. Their overall, they are trying to restructure their business in a way to improve the asset quality, especially the B2C business. So all these things put together, I think we are likely to see, the performance of the company remaining subdued. And the stock price also for a couple of quarters. So I would believe you can relook at it, but a couple of quarters down the line.
Okay, relook at it, but a couple of quarters down the line. And right now, Shaina is saying maybe you can look to switch. But on the technicals, Vaishali, is that a similar trend that you're saying, maybe book out right now and then a couple of quarters later, someone could look at it?
I totally agree. Actually, the stock has hardly given any returns. So right now, it is at a resistance of 200-day moving average. So if he's already holding it in a loss, I would say wait a while, because if the stock moves above 7,000, 7,200, maybe he can get a target of 7,500. And then I would say suggest a switch, because this is not really giving us a runaway rally in this stock. So of course, at least one can wait for a bounce.
Okay, that's the word coming in from Bajaj Finance. Maybe right now, could be a bit subdued, can look at it later on point of time, can look to sell right now. Next one is on Berger Paints. Now we have Rakesh Jain, who's writing to us from Chennai, holding 40 shares of Berger Paints, and this is at a price of 618 rupees per share. Wants to know whether he should book his losses or continue to stay invested in Berger Paints. Vaishali, what's your word on the technicals for Berger Paints?
So technically, all the paint stocks are not doing well. So right now, what I'm seeing, there is no sign of reversal also. So I would say avoid paint stocks right now. Can make a switch.
Okay, avoid paint stocks right now. So one could look to book out from this one. Shaina, what are the fundamentals looking like for the paint story? Would you also advise the viewer to maybe book out and invest somewhere else? And if yes, then where?
Yeah, I agree. The paint story is not looking too good. It's not been looking good for quite some time, actually. Even if you look at the last couple of quarters also, not been good. The margins are contracting. We've seen this across the paint, sector, across companies. And competition is, hotting up. So to that extent, I think, and valuations have always been expensive for most of the companies in the paint segment. So I would suggest switch from Berger Paints and also, from the sector itself.
Okay, switch from Berger Paints and also from the sector itself. Okay, that's the word coming in there. Let's move on to the next query. This one is on IDFC First Bank. We have Shashank, who's writing to us from Hyderabad, holding 1,000 shares at a price of 59 rupees per share. Wants to know whether to hold or exit at the current levels, making some bit of a profit right now because the stock is trading at 66 rupees per share. On the technicals, so what is it looking like, Vaishali, IDFC First Bank, given that the stock has seen a bit of a fall in the last 14 days?
So it's showing some signs of revival, but still there is no confirmation. Unless and until the stock moves above 70, 72, I think the stock is just going to be sideways because we have had several opportunities at these levels, but the momentum or the up move fizzles out. So I would say just wait till 70, 72, and then if there is a sustainability above that, then it would be a confirmation for a further strength going towards 78 and so on. So I would say wait and watch.
Okay, wait and watch. I meant 14% decline in the last 6 months is what I was indicating at. But yeah, Shaina, on the fundamentals, what is it that we are watching out for in terms of IDFC First Bank?
Yeah, I will agree. It's a wait and watch. See, what has happened is if you see the second quarter, the profits were substantially lower, both on YOY and QOQ basis. And the main reason was very big jump in provisions. Now, the merger with the IDFC into IDFC Bank has happened in October. That is post the last quarter numbers. So what I believe is that it is possible that, they cleaned up, the whole balance sheet to an extent which resulted in that poor set of numbers. So as of now, the merger has happened, but we still have to see what are the implications of the merger in terms of the impact on the asset quality, impact on their NIMs. So all these things are variable factors which actually will be clearer in the December quarter numbers or full year numbers. So what I would suggest is that keep a stop loss, maybe since it's close to his holding price, keep a stop loss and wait and watch.
Okay, wait and watch. That's a word coming in for IDFC First Bank. But that was the last query for today. So thank you so much, Shaina, as well as Vaishali, for joining in with us, as always, and solving all our viewers' stock-related queries. And viewers, do not forget that you can always email us your queries and we will address them with our experts on a Monday, Wednesday and Friday. But with that, it's a wrap on this edition of Your Stocks on CNBC-TV18. Thank you so much for tuning in. Have a good weekend, but don't go anywhere because closing bell is still there to take the action forward.
And trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. foreseeing change, growth and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook. The Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18. For 20 years, it has been India's most coveted stage for business leadership. The benchmark of unparalleled excellence.
We have to dream big and even bigger for India.
An accolade that celebrates character, integrity, and decisive action.
You just have to do your best.
Not identified by any single name, nor defined by a single achievement.
The best years are to come, and you don't have to wait for long, it's round the corner.
But redefined every year by visionaries who inspire and legends who lead. A journey that honors those who set the bar higher year after year. This is not just an award, it is a celebration of leadership in action. CNBC TV18's 20th India Business Leader Awards.
Presented by Standard Chartered in association with Reliance Industries Limited.
Inflation, on the other hand, surged above the upper tolerance band of
Hang is holding on to some bit of a gain. Taiwan index is holding on to gains right now.
The bigger resistance comes in at about 24,993.
I would think my vote also would be a CRR cut.
Through 24,699, 24,700. Remember, there's been a sharp run-up yesterday.
In India, we are overweight. We believe we're in a secular bull market.
With the first half growth that you've got, RBI could come down to 6.7, 6.8.
The policy repo rate unchanged at 6.5%.
We are calling for 25 basis points rate cut in Feb and April.
Markets higher for the 6th day in a row.
Be it rate cut, be it liquidity action, be it whatever is the action, they have to be well timed.
It's a day of a lot of updates. The mid-cap index, though, is doing really well.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Well, that is the day so far. Markets, of course, taking it a bit easy in this last hour of trading, which is coming up in front of us. I mean, it's absolutely flat. Nothing to show for it. We're coming to you live from the CNBC-TV18 Motilal Oswal Studios. I'm Prashant. With me, my colleague Surabhi, Rima, Nigel, of course, is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi, good afternoon. You know, I would say maybe nothing to show for the day, but plenty to show for the week, guys. It's been a great week for the market, right? I mean, the Nifty is chugged along about 2.5% higher. The Bank Nifty is 1.5% away from the all-time highs. Mid-caps have done well. So maybe easy Friday because the hard work has been done through the week.
And I was looking, where is Nigel? And suddenly
there he is,
in the box
on the big screen.
On the side, on the big one.
Party time, guys. It's our birthday. Party time.
Well, yeah, absolutely. You know, so just a couple of points before we go any further. So a bit of a break, right? I mean, on the Nifty and the Bank Nifty, the markets generally just treading water, not really doing very much. It's very difficult to distinguish whether this is policy related because the policy did not throw up any surprises. So there shouldn't be any worry on that front, and broader market is doing well. So those are two factors which maybe just are telling you that after it's just the run-up. I mean, and the backdrop, which has been very, very strong, that we are just kind of sort of not doing very much right now once again. So RBI CRR cut was in line. So no repo was in line. CRR cut was in line. At the margin, right? I mean, was the commentary a little hawkish? It's a question mark. I don't know. I mean, and we'll have Lata join us a little later and we'll get you more commentary. And the reason I'm saying that is because in the context of what it was, I mean, the governor essentially repeated a couple of times that we'll have to balance growth and inflation and we'll have to be very careful, etc. So not from a bond market perspective because the interpretation will be very different, but from a stock market point of view, maybe at the margin, was this a little hawkish? Yields are higher, by the way. I mean, yields are higher on the day. They're not up after the policy decision. So that's another thing. And of course, I mean, the run-up has been good, right? The mid-cap, the Nifty is up 2.3% this week. Bank Nifty is up 3% this week. And broader markets are doing well. Mid-cap index on track to gain 4% Friday to Friday. Small cap index is up 4.5%. And small cap index went up 5% last week. So that's basically almost 10% in this fortnight, in the last 2 weeks. So very heady, strong gains, especially coming through in the broader space.
You know, Prashant, I just want to say, like, on the point of the disappointment, whether this commentary was not as dovish as one would have thought and all. But if you remember, we spoke to so many commentators through the week, right? And the poll, the CNBC TV18 poll was saying that, you know, maybe 25 to 50 basis points of a CRR cut, and the governor delivered that. And a lot of commentators were saying that, look, don't expect the RBI to look at only one data point and jump the gun and do, you know, massive rate cuts and all. That's not the kind of central bank that we have. And I guess that's one of the reasons why it's so widely, you know, respected as well, that it's incremental, it's sort of very thought through. And I guess the inflation focus was very, very evident in this policy as well. Rima.
No, that is the reason I'm saying. I mean, you know, it's also what they say and what they don't say, right?
Yeah.
So, I mean, if they'd not said some of this, and then, I mean, you know, markets would have interpreted that maybe they're you know, it's our central bank speakers, and Greenspan was famous for this. And of course, I mean, you know, that was a different era. But the point is, it's what they say and also what they don't say. And I think from what they said, especially given the context of the slowdown, the 5% GDP handle, maybe, I think that's the reason why I'm saying maybe at the margin, from a stock market point of view, maybe a little hawkish is the way I would read things.
No, absolutely, because I mean, he did go on to say on record that the MPC feels that growth has bottomed in Q2, and maybe it won't be that bad. So let's see. Rima.
Well, let's just quick run through of the big movers of the day then. On the way up, it's autos. Autos are the leading sector. Bajaj Auto has rebounded after cuts in the earlier part of the week. Bajaj Auto 2.5% higher. Tata Motors, Maruti Suzuki are up 1 to 2%. Other than that, you've got an Axis Bank higher in trade, L&T, ITC, Titan, some of the noteworthy winners. On the way down, Cipla is losing ground. Cipla's lost 3.5% this week. Bharti Airtel, it's flipped and flopped both ways. Some days up, today it's down more than 1%. In the financial space, you've got HDFC Bank, IndusInd Bank under pressure. Some large cap IT names like Infi are down 1%, while Reliance Industries, that heavyweight too, is weak.
Absolutely. Just a few mid-caps to add. It's such a great day for mid-caps as well. Flourishes for all to see. Look at HBL Power Systems, 9%. Tilaknagar Industries, 9%. Borosil Renewables. You remember this company was on the channel, just a couple of days back, saying they really need more protection. They need anti-dumping duties, and that's come through. So that stock's also up and about. So mid-caps, definitely partying this Friday. Nigel?
Yeah, Tilaknagar was the one that stood out from the list that you put out there. A little bit of gin and the
Friday factor.
Yeah, gin and samsara, and I think the other one is sitara, rum. So both those two coming in from that stable. So maybe perfect Friday factor, and in December as well. So the rum blends well. But let's talk about markets. Let's have Mitesh back with us on the show. Hi Mitesh, good afternoon. Good to see you win. What about individual stocks? What are you looking at? And if you could tell us your view on the Nifty. Today it appears that's sort of a day that maybe a lot of the good news for the week at least was factored in with the run that we saw yesterday.
Oh, that's right, Nigel. I think a couple of points here. One, I'm still not sure whether we've started a new rally. So it looks like, the Nifty particularly is going through what I would call as a shift of the range on the upside. And now I need a 24,800, 820 zone to be cleared on an hourly closing basis. Till then, it could be a range between 24,500 to about 24,800, and we'll play it that way. So try to buy near the lower end of the range, try to book profits around the upper end of the range, and that's the way you take it forward. On the stock side, I have a buy on Lal Path Labs. That's a stock which is bounced back nicely today. So keep a stop below levels of 30.25. Look for a first target of around 31.20. And if it crosses 31.20-30 zone, then we'll look at eventually much higher levels being tested over here. And the other stock which I have on my radar, that's a buy on Tata Motors. Disclaimer, we have some positive or bullish bias call spreads over here, so there's vested interest. But what I want to see again here is a breakout about 810, 811. Now, once that happens, buy the stop at about 795 and look for a first target of 840, 845.
Okay. Thank you very much for that, Mitesh. We'll come back to you. We've got Prakash Diwan in the house, fresh from Goa, Paris.
Which
destination?
It's just Goa.
Okay.
Don't remind me of where next I need to go.
Where are you going next?
How's the weather? Is it hot in Goa? Or is it like Bombay-like weather? Or
It's much more cleaner though.
But is it hot or?
Goa is expected to be warm.
Yeah.
I know last time I was there, you were talking about Goa being equally hot as compared to Bombay, but no, it's far better.
We keep talking about all this urban consumption slowdown, and I'm sure you'll see none of that in Goa. I'm sure every place is packed, right? And on a more serious note, tell us from a stock perspective as well.
There was this recent survey which said it's dropped on the on the list of popular destinations thanks to a little bit of a weak infrastructure, poor transportation, which is a fact.
Yeah.
But then, at times you don't really have much of an option but to fly into Goa if you have a short weekend to celebrate and enjoy. But yeah, they could do with much more improvement.
So what are the fresh ideas?
Goa ideas or no? So Nigel
on the restaurant. I thought restaurant ideas.
I know, that's what I'm saying. Which new eateries? But
travel, tourism. Tilaknagar we were discussing.
Yeah, exactly. So I just wanted to point out that Tilaknagar is actually very popular for the brandy portfolio, and then we can talk about that at length. But consumption as a theme, probably this segment of consumption remains the most insulated. So we've always liked it. And I remember some days back you had Madhu Kela coming on your program and talking about this. So actually that's something which has been so resilient that you'll probably see people allocating more money to it. And the safest to go with is United Spirits.
I think Nigel's coming in. Yeah.
Prakash, what is the average consumption of an Indian with regard to beer that compares with the global average? What is it?
Oh, it's way, way too low. So there's lots of room.
Fathom a guess?
No, I think compared to China, we are 1/12 or something.
I think it's 2 liters versus 30 liters on an average. So Prakash, so better do your part.
But probably that 2 liters is also because of all the hard work that we put in. But no, I know I do take your point because there's a lot of rationalization that's happened on the bottling side, and on a more serious note, a couple of companies that we've tracked in the past. Their Bangalore unit, the Hassan unit, is kind of used efficiencies and AI also at times, by the way, especially in rejection rates having come down. They've used a lot of optical QC and all of that. So I'm sure there's much more happening in the industry in terms of labeling, bottling, transportation. Whereas beer making, you probably have already mastered it. You can't do much about that change. Consumption, of course, is a bit slow on other things, but not this segment.
You're talking about some of the problems in Goa. I think they should fix transportation. And I think
public transportation,
taxis
and I think it's probably still deep rooted in terms of that north-south divide, and you don't have the guys from the north wanting to go to the south and things like that. So it's still a bit of that.
It's the infamous Goa taxi mafia. Let's call it for what it's popularly called.
I think over the last 13, 14 years, I think I've spent maybe 10 Decembers in Goa, 10, 11. So,
this year too?
Maybe for a short bit. Let's see. I don't know. But Nigel, you want to say something, Nigel?
No, my first December in Goa for Christmas. I'm in Goa. Prakash, I hope to hit you up. 25th to 30th, I'm in Goa. My first time I'm going to be in Goa for Christmas. So it's going to be a special one. Prakash, look forward to catching up with you.
So absolutely, and I'm sure Goa will get more crowded given your popularity. So we'll brace up for that.
I'm getting my two little kids, so so I'm going to be pretty good. But I hope to catch up with you. And just one more point, Prakash. Since you're in Bombay, don't miss the People's Beer. It's available in Bandra now. So that's a quick one. Let me know if you don't get it.
Is this too much alcohol?
I think so, guys. I'm going to navigate back to the market. Guys, we still have a trading market to look at for the next couple of hours. So in terms of big stories, big themes and ideas for the week, banking, now we've heard what we had to hear. The MFI bit is also very well known. In terms of stocks, anything fresh? Any new ideas? NBFCs, banks, gold financiers, anything fresh?
No, so to be honest, we are very clearly waiting for some of the, and this RBI policy is probably one of the milestones that was being awaited to figure out in terms of how soon the government spending starts. And that will start impacting a lot of the infrastructure names, a lot of the capital good names, which have been sideways for a while. So you would probably start cherry picking out of that. And look at how the railways have kind of gone into this Kavach order. It's like Kavach 2.0 or whatever you want to call it, but it's significantly larger in terms of coverage and depth as compared to what it used to be. So that is a very good indication that all these projects that have been talked about and have been awaited will see that. So stock specific, it's still going to be playing safe with the bigger ones. I think the way L&T and all are also consolidated so well, I would still stick to the large caps at this point in time. There's nothing very spectacular on the small cap, mid cap yet.
Okay, in fact, talking about railways and the Kavach orders, it's Kernex Micro, which has won a large 2,000 crore order win. And that's more than the market cap of the company. Vinny joins in with the details. Vinny.
Absolutely. Good afternoon. So this order that they've gotten from Chittaranjan Locomotive Works, 2,000 crores is the order size. And like you were mentioning, 1,900 crores is the market cap for the company. So when you look at it, yes, surely a big order. They're supposed to deliver 2,500 sets on-board coverage equipment. And this is going to be delivered by 5th of December 2025. So within the next year, they are supposed to be doing this delivery. Just let's take a step forward and just look at the revenues of the company. When you look at it in the first half of the year, that is right now in Q1 and Q2 itself, they managed to just see 70 crores in terms of order revenue. Before that, in FY24, it was just a 20 crore revenue that they managed to see in terms of top line. So that is something that we have to watch out for, because when you look at it, currently in terms of net worth, also 116 crores that you would look at it. Order size is around 17 times the net worth, while in terms of the order size on an annualized basis for the first half of the year, FY25, when you look at it in terms of revenue, that would be around 14 times. So execution is going to be the key. The timeline is going to be the key, because that is going to be the main focus area, because this is a very big order win that the company has received, and how are they going to be executing it is something that we should watch out for, though a big order win, and that's why the stock is buzzing.
Okay, all right, got that. Thanks very much, Vinny. Since we were discussing the stocks specifically on these railway names, whether it's Kernex or even in HBL Power, part of their business is, I think, signaling systems, right? So that stock got very excited as well, as up 8-9% higher. Anything specifically that you would buy in railways now?
So, just as a matter of disclosure, I have a position in Kernex personally. And I'm quite familiar with the way the business has evolved over the last many years. So what Vinny said, it's something where it's taken them a long time. The company's been around for more than 20 years. It's not done anything very significant till late last year, where the first round of Kavach implementation happened. And originally, it was just 3 players, HBL, Kernex, and the unlisted play called Medha.
Okay.
So they own that patent for Kavach along with the RDSO. But now this, ordering which has started, so with this, why it's interesting is because this is, Kavach has 3 parts. One is just the locos, the locomotives. The second is the railway station, and third is the track. You need to connect all these 3 and integrate the system. This is just one part which we are talking about. The Chittaranjan Loco Works has assigned. So you'll have much more flowing down into this pipeline. So it's a very promising space. And apart from these 3 players, the OEMs, you have a lot of vendors on the EPC side who will benefit. So depending on whom they choose to go with.
Any listed? Any listed names?
Yeah, they've gone with KEC in the past.
Oh, like that. Okay.
They could go with some other listed names also. They've already, I think, indicated that they would have. But that will flow out. So as I said, this is probably one of the many things that the government could start. Look at how IRFC has behaved today. Certainly there's a lot of order book growth that is visible. I'm not recommending that to, because it's already from a price to book, it's been fairly expensive. But you could expect something coming on the rooftop solar plan, that project that the government had initiated but hasn't taken now. It's just 6% as yet. Out of that 1 crore, it's just about 6% that's been done. So there's lots which could happen in these areas. So we'll continue to revisit these companies as the orders come through.
Okay, let's get to the other big story, and that's PVR Inox, which is in focus after Pushpa 2. The Allu Arjun starrer has seen a whopping 165 crore collection on day 1. The sequel has now dethroned the Shah Rukh Khan's Jawan to become the biggest opener of all time in Hindi. Shilpa is here with the details. Shilpa.
Well, you're absolutely right. Pushpa 2, which released yesterday, has been seeing some, record-breaking collections. It has become the biggest opener for not just for the Hindi film industry, but for the Indian film industry in total. 165 crores is the net box office collections that it saw yesterday. And in addition to that, it also clocked 10 crores on the special premieres a day ahead, which was held in Andhra Pradesh, Telangana and Bangalore. Now, from the 165 crores, most of it obviously came in from the Telugu version, which was about 85 crores, and the Hindi version raked in about 65 crore rupees. And this is the data that we've got, from the industry. And like you said, it has become the biggest opener, and it has also broken the records of RRR, which was earlier the biggest opener, and that had clocked at somewhere at about 156 crore rupees, and then Jawan, which had clocked at somewhere around 65 to 70 crore rupees on their opening day. Now, I spoke to some of the movie exhibitors, and they're telling us that yesterday the occupancy levels, firstly in the 5 southern states, were about 95 to 100%, and the rest of the India, excluding the south states, was about upwards of about 75%. And the reviews of the movie have been really good from yesterday, and so they're expecting the overall occupancy over the weekend also to be similar levels of 75 to about 100%. And these exhibitors are also expecting that Pushpa 2 will go on to break records, not just in terms of the opening day, but in terms of gross box office collections, and could be the biggest Indian movie that we have seen so far. So Pushpa 2 is really staying true to its tagline, whether you call it Pushpa 2 the rule or spreading like wildfire. Record-breaking box office collections there.
Just a quick, Shilpa, thank you very much for that. Look at HBL Power. I'm not sure what has happened, but there's a sharp sell-off. I just saw the stock up 10%, 11%, actually maybe more. It's about 6% higher now. So there's about a 5% drop-off which has happened from the sort of day's high. HBL, of course, has been a multi-bagger over the last 4 years or so. I think it's up some 7-8 times at least. Kernex is still limit up about 5%. We just spoke about that a while back. I think what we'll do is we'll take a quick commercial break here. Prakash, thank you very much for joining us. Appreciate your time. Have a good trip, and
see you soon.
Nigel will hit you up. Goa,
Look forward to that. Thank you.
Well, we'll take a quick break here. We're going to come back, and there's more conversation on markets on the other side. Stay tuned.
25 years ago, CNBC-TV18 set out to be a part of India's story. Your story. For a quarter of a century, we've stood together by your side. Through every peak and every fall.
We see CNBC, the TV, and there's great content in it and great viewership.
Navigating the tides with you and becoming your trusted partner and investment ally.
I must say I don't watch business channels, but if I do watch, I watch CNBC.
Turning your dreams into legacies.
And my memories go back to you being a single room studio, to being such a huge facility, and I think from having a few thousand viewers to maybe having millions of viewers.
As we celebrate 25 years of shaping India's economic story, we reimagine the future of India's economy, a future we will continue to build together. 25 years of CNBC TV18. Let's begin the next chapter together.
Okay, welcome back. I think we've got the market, which is sort of doing nothing, 20 points lower, and we're at about 24,690. So just trending slightly sideways without too much action. Broader market is doing much better. 1,600, almost 1,700 stocks are higher, and about 1,000 stocks are down at this stage. Harsha Upadhyay is with us from Kotak Mutual Fund. Harsha, good to have you with us here on the program. As a stock market person, Harsha, how did you read the policy and the RBI policy, that is? And I was wondering aloud, only wondering.